Hello and welcome to Session 12 of the Basic Tax course. We're going to begin Session 12 with a review of the Session 10 quiz answer key. And looking at the most frequently missed questions, we'll begin with question number 1. You can claim the mortgage interest credit if you owned and occupy a home in a low-income neighborhood? Well, that's false. The only way you're eligible to claim the mortgage interest credit is if you hold the certificate, and you must acquire that certificate while you are in the buying process of acquiring your first home, or what qualifies as a definition of a first home. And it isn't even necessarily to low income, because moderate income people qualify for that credit. The credit is based on having a certificate, and the certificate is issued when you purchase a home in a qualifying neighborhood and your income is within the qualifying ranges. Absolutely nothing to do with being low income. Moving on to the next most frequently missed question, number 7. The credit for prior year minimum tax is a refundable credit, or is it a non-refundable credit? Well, the answer is it's both. We didn't get into a real discussion of what generates the credit for prior year minimum tax beyond saying that it is allowed only when you have deferral items that create a difference in tax for the year AMT is assessed, but over time those items would still be allowed under AMT. And in certain cases, the credit is refundable. In most cases, the credit is not refundable. But the answer to question number 7 is that the credit is both a refundable credit and a non-refundable credit, just as we have a situation where the additional child tax credit is a refundable credit, or the American Opportunity Credit is a refundable credit and a non-refundable credit at the same time. Next question in line is question number 9. Providing you meet the requirements, your retirement savings contribution credit will be 25 to 50% of your contribution. Well, that is false. The retirement savings contribution credit ranges anywhere from 0 to 50%, not 25 to 50%. Number 12. The maximum lifetime learning credit you can claim is $2,000 per eligible student you claim on your return. That is false. The maximum lifetime learning credit is $2,000 per return. So you could have 10 students that you claim on your return, and all of them would be eligible for the lifetime learning credit, but the total credit you can claim is $2,000. Let's compare that with the American Opportunity Credit, where the maximum credit is $2,500 per student. Next in line, which of the following statements is true? The American Opportunity Credit is 100% of the first $4,000 of qualifying expenses. No, it is not. It's 100% of the first $2,000 of qualifying expense. The Lifetime Learning Credit is 20% of the first $2,000 of expenses. That is false as well. It is 20% of the first $10,000 of expenses. And finally, C, with 3 qualifying students on your return, you could claim a combined American Opportunity Credit of $7,500 if each qualifying student had $4,000 or more of expenses. Well, that is the true statement, because remember, the American Opportunity Credit is 100% of the first $2,000 of expenses and 25% of the second $2,000 of expenses. So that would give you, if you had $4,000 of qualifying expense, a credit of $2,500. And if you have 3 qualifying students that are being claimed on a tax return and each student had $4,000 of expense, yes, this is a true statement. The combined credit could be $2,500 each, or $7,500 for the 3 of them. So that concludes the review of the quiz answer key. It is now time to move on to a review of the Session 11 homework assignment. And I did make the Session 11 homework assignment a little bit more work than is usually the case, but I really felt it was important for you to have an opportunity to work through multiple situations where you were dealing with a combination of the Earned Income Credit, the Head of Household Filing Status, different family situations, and the Child Tax Credit, and of course the Child Independent Care Credit. And really the only way to do that was just to throw a bunch of homework at you. So by the time you got through it, I hope you had a lot of different questions in your mind and that you were puzzling through a lot of different tax scenarios and really wondering whether you're getting any of it right. So in this review, you will be able to see how you did. And if after the end of this review you have any further questions, please do feel free to use the Q&A forum. And we'll begin with Homework A. The forms needed as a part of Homework A were Form 1040 and Form 8812. Jack Spratt lives at 1666 Southeast Mother Goose Lane. His wife, Betty, moved out of the house in August and left the care of their 3 children to Jack. And they will not be filing a return together. Go ahead and prepare Jack's tax return. Now, the first thing we observe here is that because Betty moved out of the house after the middle of the year, Jack cannot show that he meets the requirements for being considered unmarried. To be considered unmarried, he would have to maintain a home for his children, and his wife cannot have lived with him in the last 6 months of the year. And since she moved out of the house in August, obviously she was there during the last 6 months of the year, so the head of household filing status is out. He's essentially left with joint or married filing separate as his options, and we're going to do married filing separate for Jack. So Jack is eligible for a $400 making work pay credit. He has 3 children, Angelique, Dominique, and Veronique, and they were born in the years 1996, 1998, and 2001. And if you look at those years of birth, you will see that they are all under age 17, and that would make them all eligible for the child tax credit. Now let's take a look at Jack's income, and we'll see that Jack's income for the year is only $21,000. Just mentally doing the math in your head right now, you should already be able to predict that with that many dependents, he's going to get his taxable income down to 0. And if his taxable income goes down to 0, it means he's going to be eligible for the additional child tax credit, and that's why we asked you to complete Form 8812 up here. So let's go over and take a look at his finished answer key now. This problem really is a good illustration of how undesirable the married filing separate status can be. And since Jack lived with his wife in the last 6 months of the year, he's going to be left with married filing separate as an option. And because he's filing married filing separate, he cannot claim the earned income credit. But he is still able to claim the additional child tax credit. Now, taking a look at the instructions for Form 8812, 8812 does offer 2 ways to calculate the additional child tax credit, and Jack can use whichever way offers him the largest credit. Part 1 calculates the credit as a percentage of earned income in excess of $3,000, and to the extent his income exceeds $3,000, he multiplies that difference by 15%. Part 2 of the form calculates the credit as a refund of Social Security and Medicare tax paid from W-2 withholdings or self-employment tax. So Jack is able to figure his additional child tax credit 2 different ways, and he'll go with whichever way gives him the bigger refund. And here is Jack's Form 1040. We see that his filing status choice is married filing separate. He has to list his spouse, Betty Spratt, on the return, and he shows her Social Security number here up on the spouse Social Security number line. He claims an exemption for himself. He claims 3 exemptions for his children, and total exemptions on the return is 4. His only source of income was 1 W-2 showing $21,000 of income. We move over to page 2 of the return, and we claim the standard deduction of $5,700. We also claim an exemption deduction of $14,600. That would be 4 times $3,650. We get taxable income of $700, and from the tax tables, that gives us $71 of tax. He will reduce his tax by $71 by use of the child tax credit, and that gets his net tax down to 0. Next, we look to his W-2s, and there was $1,200 of withholding. We've already told you he is eligible for a $400 making work pay credit, but now we have a calculation down here for the additional child tax credit, and it comes out at $2,775, but let's just go take a look at where that number came from, or how we got that number. Firstly, we look to line 1 of the Form 8812. Line 1 says take the number of qualifying children you have and multiply that number by $1,000, and we get 3 children times $1,000, or $3,000. The next instruction is to take the amount of child tax credit claimed on line 51 of Form 1040. That was $71, and we subtract that out. We get a net difference of $29.29. Next, we look at where his income is coming from. He had earned income of $21,000, but what's this $500 amount, and where did it come from? Well, let's go take a look at his W-2. We'll see on his W-2 his income is $21,000, but there is this amount shown on box 12 with a code Q. And code Q represents non-taxable military benefits, and those military benefits can be used to increase the amount of earned income for purposes of calculating the additional child tax credit. You can also use this amount optionally to see if we can increase the amount of earned income credit that Jack is eligible for. But since Jack's not eligible for the earned income credit in this problem, you're going to use this $500 amount only to increase the amount of income that will be used for purposes of calculating the additional child tax credit. So you can see code Q represents non-taxable combat pay. We enter that amount on line 4B, and that increases the amount of income he has for purposes of calculating the additional child tax credit up from $21,000 to $21,500. Now we subtract out $3,000 and we end up with $18,500. The next step is to take $18,500, multiply that by 15%, and enter the result on line 6, which is $27.75. Now in part 2 of the form, we look at the amount of Social Security and Medicare tax that was withheld on the W-2. And to do that, you go over to box 4, $1,302. We add in the amount on box 6, $305, and the result is $1,607. We enter that on line 7, and ultimately we see that the amount allowed for under Part 2 of the form is actually less than the amount allowed for under Part 1 of Form 8812. So ultimately, the calculations that occurred in Part 1 of the form give us the better result. We're going to carry $2,775 back up to the 1040, enter that on line 65, add the amount on line 65 to the amounts on lines 61 and 63, and we get $4,375. And that is Jack's refund for the year. Now let's take a look at problem number 2, or homework assignment B rather. In homework assignment B, we're assuming all the same facts as in assignment number A, except we're going to have Jack be divorced. And since Jack is now divorced, he would be eligible for the single filing status. He would also be eligible for the head of household filing status. And under either of those statuses, he is now eligible for the earned income credit. So let's take a look at the answer key for homework B. Under homework B, Jack qualifies for earned income credit. Claiming the earned income credit affects the calculation of the additional child tax credit in Part 2 of Form 8812. Since the amount of additional child tax credit calculated in Part 2 of Form 8812 is reduced by any EIC Jack receives, he should use Form 8812 Part 1 to calculate his additional child tax credit. Well, the reality is Part 1 is giving him a bigger number in both situations, but earned income credit is another reason why the amount of child tax credit shown in Part 2 of Form 8812 could go down. You should note that Form 8867, Paid Preparer's Earned Income Credit Checklist, is also included for your review. IRS has stepped up enforcement of preparer compliance with regards to the earned income credit, and the Form 8867 Preparer Checklist must now be manually completed inside software programs so that it is no longer a default form created by tax software, which has been the case in earlier years. Jack, as I already said, meets the qualification for head of household, and he will claim for exemptions. Now, regarding the earned income credit, we have calculated earned income credit in our answer key of $4,702, and this is based on having 3 or more qualifying children. You will need to complete Schedule EIC as shown in this answer key. And even though you don't see anything in the instructions that tell you to put the youngest child first, this is simply a routine that has been in place because it used to be included in the IRS instructions, and software companies fairly much follow a pattern that has been set over time, which is to list the youngest children first on the form. When you're filling out for Schedule EIC, you need to enter each child's name, Social Security number, year of birth, relationship to the taxpayer, and the number of months in the home. And here is Jack's Form 1040. We show filing status this time around is head of household. We have the same 3 dependents and the same 4 exemption deductions. We have the same income, $21,000. On line 40, the standard deduction has gone up to $8,400 for head of household. The exemption deduction is $14,600. That is unchanged, and we're left ultimately with taxable income of 0. We go over to line 61 and enter that same W-2 withholding of $1,200, the same making work pay credit, but this time we have entered earned income credit in the amount of $4,702. Interestingly, the child tax credit, or the additional child tax credit rather, has not changed, and that's because the amount of income he has not changed. And look at this, a nice refund of $9,077. So what a difference the earned income credit makes. Here is Schedule EIC. You'll see that we entered the name of each child with the youngest first, the children's social security numbers, the years of birth. No child was over the age of 19 during the year, so we do not need to complete box 4. And on line 5, we've entered the relationship of the children to the taxpayer, and the number of months the children lived with the taxpayer during the year is 12. On the additional child tax credit form, nothing has changed, with the exception of line 2. Line 2 had $71 on it for the first homework assignment, but on the second homework assignment, taxable income was 0, tax is 0, so no child tax credit is claimed on line 51 of Form 1040 for this second illustration. The non-taxable combat pay is still included on line 4B, and ultimately the amount of additional child tax credit calculated on line 6 is the same as it was in the earlier illustration. Now here on Part 2 of Form 8812, we do see that there is an entry made on line 10 for the amount of earned income credit. The amount of earned income credit reduces the amount of additional child tax credit allowed for in Part 2. Ultimately, line 11 on this illustration is 0, where it was $1,607 in homework assignment A. And here is a completed Form 8867 as filled out by our tax software program. We did have to manually go into that software and answer questions. As I pointed out earlier, the IRS's checklist that appears in Pub 17 may differ from the 8867 that you fill out in tax software, or a substitute Form 8867 that you may fill out instead of 8867. Ultimately, what matters is that the questions are asked and a record of the responses from the tax client is maintained. Moving on to homework number C. Homework number C is a creation of my imagination, but it really is so close to the reality of so many of the tax clients I work with each tax season. This is a very common household makeup, an unmarried couple who live together. They might have children of their own that they've had together, but they also have children from prior relationships. And so you really have almost a state of confusion for the tax preparer to sort through the details of that particular household situation and ultimately establish how to file returns. And when I uncover a situation like this one, I really encourage my client to bring in their unmarried partner so that we can really sort out who's going to claim what and who will benefit most by claiming which child, because it really is possible to make decisions about who will claim what child, and my job as a tax preparer is to give them good tax advice that will minimize their tax and do so legally. So let's take a look at the problem. It says that Jack and Sylvia are an unmarried couple who lived together all year. They paid more than half the cost of supporting the following children who lived with them all year. We have the dependent named George, who is age 9, and his relationship to Jack is son, but he is not a child of Sylvia. We have Samantha, age 12, who is a daughter of Jack and not related to Sylvia. We have Ben, who is a son of Sylvia, but not related to Jack. We have Becky, who is a daughter to both Jack and Sylvia. And then we have Jonathan, who is not related to either of them. Looking at the ages of the children, we see that all of the children are under age 17, but which of these children will be eligible for the child tax credit? So that's a decision that you have to make. And we also have to look at which of these children can qualify Jack and Sylvia for the earned income credit. Jack's earned income and adjusted gross income is $23,000. He paid 51% of the cost of keeping up a home. He received $200 of housing assistance each month last year and paid $500 for the after-school care of George during the year. Sylvia's earned income and adjusted gross income is $24,000. She paid 49% of the cost of keeping up the home. She received $400 in food stamps each month of the year. Sylvia paid $2,500 of child care expense for Becky during the year. Go ahead and answer the following questions based on the information I've provided. So here are the questions for discussion and my answers. Number 1, what is the filing status of Jack? Well, the answer is Jack is head of household because Jack is the one that paid 51% of the cost of keeping up the home. Now, you might have been confused for a minute because Jack earned less than Sylvia. But the question for head of household is not who earned the most, but rather who paid more than half the cost of keeping up the home. And we've gone out of our way to tell you that was Jack. So Jack is eligible for the head of household filing status. Some facts to consider. Jack paid more than half the cost of keeping up a home for himself and a qualifying child. So George, Samantha are Jack's qualifying children, and if Sylvia agrees to let Jack claim Becky, then Becky is also Jack's qualifying child. Please note that Sylvia has the higher income, so she is able to claim Becky under the tiebreaker rules, and therefore must agree to release Becky's exemption to Jack in order for Jack to be able to claim her. And of course that would be done with Form 8332. Question number 2, what is the filing status of Sylvia? Well, the answer is single. What facts do you need to consider? Well, Sylvia has the highest income, but she did not pay more than half the cost of keeping up her home. Her children can qualify her for dependency exemptions, the child tax credit, and the earned income credit, but not the head of household filing status. Question number 3, which children could Sylvia be able to claim as dependents on her tax return? Well, the answer is Ben, Becky, and Jonathan. The points that you should consider: George and Samantha are Jack's qualifying children. George and Samantha could be Sylvia's qualifying relative, except for the fact that a qualifying relative cannot be the qualifying child of another filer. Thus, George and Samantha cannot be Sylvia's qualifying relatives because they are the qualifying children of Jack. Jonathan is not related to either Sylvia or Jack. Therefore, his dependency exemption is claimed under the rules for qualifying relative, and he cannot be a qualifying child of either Jack or Sylvia. Which children could Jack be able to claim as dependents on his return? Well, the answer is George, Samantha, Becky, and Jonathan. Points to consider: Ben is Sylvia's qualifying child. Ben could qualify as Jack's qualifying child, except for the fact that a qualifying relative cannot be the qualifying child of another filer. Thus, Ben could not be Jack's qualifying relative because he is Sylvia's qualifying child. Now, Jonathan is not related to either Sylvia or Jack. Therefore, his dependency exemption is claimed under the rules for qualifying relative, and he cannot be a qualifying child of either Jack or Sylvia. Name the children Sylvia could claim for the child tax credit on her return. Well, the answer is Ben and Becky. The points to consider: Ben and Becky are under age 17. They are Sylvia's qualifying children, and they meet all tests for the child tax credit. Jonathan could qualify as Sylvia's dependents under the qualifying relative rules, but cannot qualify her for the child tax credit. Number 6, name the children Jack could claim for the child tax credit on his return. Well, this is not a question of which one should he claim, but rather could claim if Sylvia agreed to let him do it. And the answer is George, Samantha, and Becky. The points to consider: George, Samantha, and Becky are under age 17. They are Jack's qualifying children and meet all tests for the child tax credit. Because Becky is also Sylvia's qualifying child and Sylvia's income is higher than Jack's, Sylvia must release Becky's dependency exemption to Jack if Jack wants to claim Becky for any tax benefits. So which children could Sylvia claim for the earned income credit? Well, the answer is Ben and Becky. Points to consider: Ben and Becky are under age 19. They are Sylvia's qualifying children and meet the relationship, age, and residency tests for the earned income credit. Since Jonathan is not related to either Sylvia or Jack, he cannot be a qualifying child of either of them. Thus, Jonathan could qualify as Sylvia's dependent under the qualifying relative rules, but does not qualify her for the earned income credit. Number 8, Which children could Jack claim for earned income credit? Well, the answer is George, Samantha, and Becky. The points to consider: George, Samantha, and Becky are under age 19. They are Jack's qualifying children and meet the relationship, age, and residency test for the earned income credit. Since Jonathan is not related to either Sylvia or Jack, he cannot be a qualifying child of either of them. Thus, Jonathan could qualify as Jack's dependent under the qualifying relative rules, but does not qualify him for earned income credit. Number 9. Can Sylvia claim the child independent care credit? And if yes, for which children? Well, the answer is no, she can't. And this may be surprising to you. The point to consider is that Sylvia did not pay more than half the cost of keeping up her home. So she fails the keeping up a home test and therefore is not eligible to claim the child independent care credit. The sad thing is that Jack cannot claim the child independent care credit for expenses paid for his daughter Becky either. And the reason is he did not pay the expense. Sylvia paid the expense. Sylvia is not eligible to claim the credit because she did not pay more than half the cost of keeping up a home. And Jack is not eligible to claim the credit because he did not pay the expense for his daughter Becky. Now, can Jack claim the child independent care credit? And if so, for which children? The answer is yes, and the child is George. The points to consider: Jack can claim child care expenses he paid during the year because he has a qualifying child for whom he paid expenses, and he paid more than half the cost of keeping up his home. Sylvia paid child care expenses for Becky, but Jack cannot claim expenses for Becky that he did not pay himself. Number 11. What are the possible tax return and potential refund scenarios for Jack? Compute the refund scenarios for possible tax situations by completing the following chart. So what we did is we gave you a blank chart and we said list Jack's AGI and the amount of various tax benefits he would get based on claiming various dependent situations. So we've done that for you. Well, in every case, his AGI is the same, $23,000. In every case, his head of household filing status standard deduction is the same, $8,400. Now, depending on the number of dependents he claims, his dependency deduction will vary. We go everywhere from $10,950 as a low all the way up to $18,250 as a high. What is his taxable income? Well, his taxable income is $3,650 only in this first situation where he claims only 2 dependents. His tax would be $368. He would figure his child care credit as follows: $500 times 31%. That's where he falls on the table for calculation of the child independent care credit on Form 2441. That gives us a $155 credit. His child tax credit is $213, and we simply take his tax, subtract out the child independent care credit, and we're left with the amount of tax he has left, and that's offset with the child tax credit. We then have total tax after non-refundable credits of 0, a making work pay credit of $400, and if we go look up the earned income credit on $23,000 of income with 2 qualifying children, we end up with $3,651. His additional child tax credit will be $2,000 minus the amount of child tax credit claimed up here. So that leaves him with $1,787 of additional child tax credit. That gives him a refund due to tax credits of $5,838. It doesn't matter how much tax he had withheld, he will still get this amount of money as a minimum. Now, what happens if we give Becky to Jack? Let's just suppose that Sylvia is willing to sign Becky over and allow Jack to claim her. Well, in that situation, we have $23,000 of income. Standard deduction is the same, but we have enough exemption deduction that his tax goes down to 0. Since his tax goes down to 0, none of his child tax credit gets used up here. Also, there's no point in even bothering to calculate the child independent care credit. His tax is 0, so that credit is of no use to him. So we see that he's allowed his additional child tax credit of $3,000 in full down here. Because he is claiming the earned income credit for 3 children, his earned income credit would go up, and his potential refund could go as high as $7,681. Now, what happens if we give the dependency exemption for George to Jack so that he claims George, Samantha, and Jonathan? Well, in that situation, we also get the taxable income down to 0, but the earned income credit can only be based on 2 children, not 3, and the additional child tax credit can only be based on 2 children and not 3. So he ends up with a refund of $6,051 in that scenario. Now you might be asking, does he meet all of the tests for claiming Jonathan as a dependent? We really don't tell you specifically whether it was Jack or Sylvia that paid more than half the cost of supporting Jonathan. Under the rules for qualifying relative, you have to show that you paid more than half of this person's total support. Ultimately, I haven't given you enough information to know whether it's Jonathan or Sylvia, but either way it would be pretty darn close. So we've basically said either way we're going to give Jonathan to either of them just to see how that would calculate out. Now in the final scenario, we have Jack claiming George, Samantha, Becky, and Jonathan. The exemption deduction goes up to $18,250, but it really changes nothing. What does change is Becky. We add her back in, so we get the child tax credit for 3 children, we get the earned income credit for 3 children, and we can see here that if Jack claims all 4 of those children, his refund is no different than if he only claimed 3 of the children. In scenario number 12, what are the possible tax return and potential refund scenarios for Sylvia? We compute the refund scenarios as follows in this chart. Well, Sylvia's adjusted gross income is higher, and her options are to claim only Ben, to claim Ben and Becky, or to claim Ben, Becky, and Jonathan. And we look at a standard deduction of $5,700, an exemption deduction of $7,300 if she claims only Ben. And if she claims only Ben, she'll have taxable income of $11,000. Her tax would be $1,235. She would not get a child care credit. She would claim a child tax credit of $1,000, and that would leave her with tax after non-refundable credits of $235. We'll subtract out the making work pay credit. We'll give her an earned income credit for 1 qualifying child in the amount of $1,839, and that gives her a refund due to tax credits of $2,004. In this scenario, we're essentially saying Sylvia would claim Ben and no one else. And if that were the case, then we would be giving Jack these dependents over here. And Jack would have a potential refund of $76.81. Sylvia would settle for $2,004. Now let's look at another alternative. We give Sylvia both Ben and Becky, and we give her the same income amount. We up her exemption deduction a little. Therefore, her taxable income drops. Her tax calculation goes to $738, and her child tax credit would drop to $738. And actually, she would now qualify for the child tax credit on 2 children. So we subtract $738 from $2,000, and we end up with $1,262 being the difference that she could claim as an additional child tax credit. The earned income credit for 2 children with income of $24,000 is $3,441. So if Sylvia were to file under this scenario, she would get a refund of $5,103, and if she were to do that scenario, then of course we would not give Becky to Jack. So in this situation, Jack would claim George, Samantha, and Jonathan and get a refund of $6,051, and $5,103 would go to Sylvia. And let's look at the final situation. Ben, Becky, and Jonathan all being claimed by Sylvia. We end up with exemption deductions of $14,600, taxable income of $3,700, and income tax of $373. We're going to use the child tax credit to reduce that taxable income down to 0. And of course, $373 of child tax credit is subtracted from the maximum potential additional child tax credit of $2,000. The difference is $1,627, and we've entered that here. The earned income credit is not changed. Jonathan does not qualify as a third person that could increase the amount of earned income credit that Sylvia is eligible for. So ultimately, she's stuck with that same EIC amount, and we have potential refund here of $5,468. Now, ultimately, the best possible scenario for these 2 individuals, that is Jack and Sylvia, is going to be the best combination of these refund amounts. Ultimately, this refund here, $5,468, is the maximum refund Sylvia could receive. And if we add that to this refund here, $5,838, we'll see that we have the best possible tax scenario. So here I've taken the various scenarios or potential refund amounts for each Jack and Sylvia. And when I do that, you'll see that in the scenario where Jack claims only his 2 children, George and Samantha, he gets a refund of $58.38. And if he does that, then Sylvia can go for this refund amount here on Becky, Jonathan, and Ben. And we take those two amounts, $58.38 and $54.68, and add them together, and we get $11,306. Another possible scenario is to give Jonathan to Jack and not to Sylvia. And if we do that, we would calculate a refund for Jack in the amount of $6,051 and a refund of $5,103 for Sylvia. When we take those two numbers and add them together, we get $11,154. So we can see in that formula that it is not better for Jack to claim Jonathan. The final scenario is to really give Jack everyone and just give Ben to Sylvia. But if we do that, we end up having a combined refund of $76.81 and $2,004. When we add those numbers together, we get only $9,685. So that's definitely the least advantageous option for Sylvia and Jack. Ultimately, the choice of who claims Jonathan, really the dependency test would determine who gets Jonathan. We would have to see who passes the test of paying more than half of Jonathan's support. That information was not given, but it's such a tight line that ultimately whoever claims him, it just makes the slightest difference combined refund for that household. Number 13. Based on the calculations that you completed for questions 11 and 12, what would be the best way for Sylvia and Jack to divide the dependency exemption of all 3 children between them so that the overall best tax situation is realized for their family? The answer is that Jack should claim George and Samantha, and Sylvia should claim Ben, Becky, and Jonathan. Points to consider. The EIC for 3 children, if Jack claims EIC for George, Samantha, and Becky, is $4,281. That's $630 more than if Jack claims EIC for only 2 children. The EIC for 2 children, if Sylvia claims Ben and Becky, is $3,441. That's $1,602 more than if Becky claims EIC only for Ben. This means that Sylvia benefits $972 more by claiming Becky for EIC than Jack does if he claims Becky instead. Thus, it is more advantageous for Sylvia to claim Becky as a dependent than it is for Jack to claim Becky. Now, if Jack claims Jonathan as a dependent, his taxable income drops to 0. He will not benefit from claiming a credit for his child and dependent care expenses because his tax is already 0. If Becky claims Jonathan as a dependent, she will benefit in full from his exemption. Thus, it is better for Becky to claim Jonathan than it is for Jack to claim Jonathan. The dependency exemptions and the child tax credit amounts for each child benefit Jack and Sylvia equally. The difference in tax savings that help Sylvia more than they help Jack have to do with differences in the earned income credit amounts and the benefit of the child and dependent care credit to Jack. So that concludes the review of the Session 11 Homework C answer key. At this point, please push pause on video playback and go to the LMS and take the Session 11 quiz. When you are ready, resume playback and we will begin the Session 12 lecture. And welcome to Session 12. This is a jam-packed full session. It's one of those sessions I kind of call a mishmash session. It's like everything left over, we had to stick it somewhere, and this is where we put it. And so today we're going to be covering a lot of different things, some of them interesting, some of them not so interesting, but in general people tell me they enjoy this session. So we're going to discuss other taxes including uncollected Social Security and Medicare tax, also household employment taxes, estimated taxes, the penalty for underpayment of estimated tax, installment agreement request, amended returns, the Kiddie Tax, and the alternative minimum tax. Your reading assignment for today's session is shown here. And let's move on with the first topic of the day, which is other taxes. Even if you owe no income tax with your return, you may still owe other taxes with your return. Lines 56 through 59 on page 2 of Form 1040 are used to add taxes that are in addition to your income tax. So other taxes are reported on lines 56 through 60 on the second page of Form 1040. We're going to take each of these taxes in turn, beginning with self-employment tax. You must file Schedule SE to calculate your self-employment tax if you have a net profit from any of the following: self-employment, farming, active participation in a partnership, certain 1099 miscellaneous compensation, or wages of certain church employees. Self-employment income will be covered in Session 18 of the Basic Tax course. We'll just leave this description as it is for today. The next line on the back of the Form 1040 is line 57, unreported Social Security and Medicare tax from Form 4137 or from Form 8919. Well, earlier in the course we talked about how to complete Form 4137, which is used to report tax on tips. There are other situations, though, where you may still be required to pay tax on wage income that you received, and if you fall under those requirements, Form 8919 is used for that. Form 8919 is the form used to report uncollected Social Security and Medicare tax on wages. If you worked as an employee, your employer should have issued you a Form W-2, reporting total wages, salaries, and tips paid to you for the year. If, however, your employer treated you as an independent contractor by issuing you Form 1099 miscellaneous, instead, you may use Form 8919 to figure and report your share of uncollected Social Security and Medicare taxes that are due on your wages. By using Form 8919, your Social Security and Medicare taxes will also be credited to your Social Security record. Do not use Form 4137, Social Security and Medicare tax on unreported tip income, for this purpose. You must meet one of several criteria before you are allowed to use Form 8919, and unfortunately, I have found as a tax professional that these criteria are such that I have yet to have a client who's been willing to file this form. Now, when the form first came out, I thought, oh, well, that's interesting. And this form, by the way, 8919, has only been out for around 3 or 4 years now. It's a fairly recent form. And up until 3 or 4 years ago, it didn't exist. IRS was basically trying to close an area in the law that was causing some confusion, and that is what to do if you've been a misclassified worker. Perhaps someone's issued you a 1099 miscellaneous instead of giving you a W-2. And what do you do in those situations? Well, historically, what I always did as a professional, and what was the accepted method of dealing with a problem, was to file using a substitute W-2 and essentially dispute the allocation from that employer, saying, I am an employee and I am not an independent contractor. Well, with Form 8919 being in existence now, it's not that simple anymore. And let's look at why. In order to file Form 8919, you have to meet these criteria, at least one of them. That is that you filed Form SS-8, Determination of Worker Status for purposes of federal employment taxes and income tax withholding, and you received a determination letter from the IRS stating that you are in fact an employee, even though you've been treated as an independent contractor. Or you have been designated as a Section 530 employee by your employer or by the IRS prior to January 1, 1997. Or you received other correspondence from the IRS that states you are an employee. Or you were previously treated as an employee by the firm and you are performing services in a similar capacity and under similar direction and control. Or your co-workers are performing similar services under similar direction and control and they are treated as employees where you are not. Or your co-workers are performing similar services under similar direction and control, and they filed Form SS-8 for the firm and received a determination letter that they were employees. Or finally, you filed Form SS-8 with the IRS, and if you have not yet received a reply. Well, what Form SS-8 does is it essentially asks the IRS to come in and establish whether or not you are an employee. So what in effect happens is the IRS does an investigation, and I have yet to find a tax client who is willing to open up an investigation on the part of the IRS where the IRS would examine whether or not they meet the criteria for being an employee. And this is the case even when they don't any longer work for the particular employer. And in many times they've been unfairly treated by that employer, and they still don't want to challenge the employer even after they've lost their jobs. So I can see a little bit that a worker who has a job and is afraid of losing it might not want to open the doors for an investigation because they might just be afraid they'll lose their job if they do. But if the worker is no longer employed there, what have they got to lose? Well, frankly, not much. They have everything to gain because they could basically be in a situation where their ex-employer is going to have to pay 50% of their Social Security and Medicare taxes for them, as opposed to them having to pay all of those taxes themselves. And yet, I have had zero success rate with encouraging my clients to fill out this form. And believe me, I've tried. But here is the form 8919, and you will see that it lists who can file the form and the reason code that you must enter on the form. And it's this reason code that is a problem. I've never had a client that qualified under reasons A through F, and I've never had a client willing to follow through with reason number G. Thus, I've never been able to talk a client into filing this form. However, if you do manage to talk a client into filing the form, the purpose of the form is to expose the wages of the employee to Social Security and Medicare tax. You enter the amount of wage income that the employee received for the year. You multiply that wage income by 0.062 Social Security tax and 0.0145 Medicare tax. The tax that you calculate on line 13 carries over to Form 1040 and is entered on line 57. You check box B and you enter the amount of uncollected Social Security and Medicare tax on line 57. The next tax of the day is household employment taxes. These taxes are reported on Form 1040, line 59. And you can see that there is a box that you check on line 59, box B, for Schedule H. Well, here are the rules for completing that form. If you had a household employee during the year, you may be required to pay Social Security and Medicare taxes for your employee. If you choose not to file Form 941, the Employer Quarterly Federal Tax Return, you can file Schedule H for household employment taxes instead and include the taxes owed on your employee wages with your personal return. You are required to file Schedule H if you do not file Form 941 and you paid wages of $1,700 or more to any one household employee during the year, or $1,000 or more in any calendar quarter of 2009 or 2010 to all household employees during the year. And if this is the case, you must apply for an employer identification number, issue a W-2 to every employee that you paid $1,700 or more to during the year, and you must do so by January 31 of 2011. And you must also file Forms W-3 and W-2 with the Social Security Administration by February 28, 2011. Well, that sounds kind of like a lot to do. You just hired a nanny to come watch the kids for a few weeks, and now you got to give them a W-2 and file all these reports? What's up with that? Well, it has to do with something that you may commonly hear referred to, at least in the news media, as the nanny tax. And essentially, it isn't a nanny tax. It is the case that when you are an employer, as an employer, you are required to do Social Security and Medicare tax withholdings and then pay those withholdings to the Social Security Administration or the IRS. And there's no exception because the employee you happen to employ is a household employee. Employment laws are employment laws, and if you have an employee, you have to pay employment taxes. Now, the thing is that when you have a household employee, the IRS has tried to make it easier for taxpayers to pay the taxes on their nannies or, say, their other household workers. And the way they make this easier is by allowing the taxpayer to file a Schedule H and pay all of the payroll taxes at one time on Schedule H at the end of the year, rather than through this alternative system of filing Form 941 and paying taxes quarterly. So as an employer, you are responsible for withholding and paying Social Security and Medicare taxes for your employee on the wages that you pay them. You should withhold 6.2% of gross wages for Social Security and 1.45% for Medicare tax. I do want to point out that that rate of withholding has dropped to 4.2% in 2011 only. You may also, if you and your employee choose to, withhold income taxes for your employee. Now, if you fail to withhold Social Security and Medicare taxes, you must pay both your employer's share and your employee's share of the taxes. Employers who do not withhold must pay both the employer and the employee's share of the payroll taxes. The employer and not the employee is responsible for payment of the tax. So you cannot have the argument, therefore, that, oh, my employee is going to be responsible for their own taxes. I'm not going to W-2 them at all. Well, frankly, it's illegal, unless, of course, you paid them less than $1,700 for the year, or the total of all wages paid to all household employees for the year was $1,000 or less in any quarter. Those are the only situations where you get to do nothing. And if you pay your employee more than $1,700, then you are required to issue a W-2 and you are required to pay payroll tax for them. And here's an illustration of how we would go about calculating the payroll tax. Julia employed a nanny to care for her 2 children. She paid her nanny $12,000 during 2010. Her EIN is shown here, and during the year, Julia withheld $500 of income tax and 6.2% Social Security and 1.45% Medicare tax. Julia paid a state unemployment fund contribution of $144. Her state EIN is shown here. After completing the state report and paying any tax due, Julia should prepare and file Schedule H as follows. Here we have Schedule H for Julia. Social Security number, she has had to acquire an employer ID number and enter that on the form. We enter the amount of wages paid to the worker, and then we show the Social Security tax apportionment for that. Now, the rate of withholding that Julia does is 6.2%, but that 6.2% represents only half the Social Security tax. The total Social Security tax is actually 12.4%. So she's going to take $12,000, multiply that by 12.4%, and she enters that total on line 2. So the Social Security component of the household employee tax that she needs to pay is $1,488. Next, she does a similar calculation for the Medicare tax. Medicare tax is 2.9%, and that gives her $348 of Medicare tax. Next, she enters the amount of withholding she did from employee pay. That was $500. She enters that on line 5. And then she figures her total Social Security and Medicare tax and withholding taxes at $2,336. So we end up with net Social Security, Medicare, and withholding taxes on line 8. The next step is to move over to page 2 of Schedule H to do additional calculations revolving around unemployment tax. But before we go there, I wanted to give you the password to open the Session 10 quiz answer key. That password is X-Wing, as in X-Wing fighter that Luke Skywalker flew in Star Wars. And moving on to page 2 of Schedule H, you should note that all states do have an unemployment fund that businesses are required to contribute to. When you prepare Schedule H, the tax preparer should make inquiries of the taxpayer to determine if the taxpayer has properly established a state payroll tax account and filed the appropriate state payroll tax forms. The reason for that is that when you file the Schedule H, you are paying only taxes due to the federal government. And when you have household employees, it is most likely the case that you also have state payroll tax obligations. And you should research at the state level the type of state taxes your client might need to pay and figure those taxes and obviously tell your client how much they are. Now, Part 2 on page 2 of Schedule H, you need to go through and answer these questions. Did you pay unemployment contributions to only one state? Did you pay all state unemployment contributions for 2010 by April 18, 2011? And were all wages that are taxable for FUTA also taxable for your state's unemployment tax? We've answered yes to all 3 of those questions. And because we answer yes to all 3 of those questions, we now go to Section A of Schedule H. We enter the state where the unemployment contributions were made, and we've just indicated Oregon, randomly picking my home state there. Contributions to that state unemployment fund, we told you in the wording of the problems that those were $144. It's now time to figure the amount of FUTA tax, or federal unemployment tax, that we need to assess on this worker's wages. Interestingly, not all of the wage is subject to FUTA tax, only the first $7,000 is. So we take $7,000, multiply that point by 0.008, and we end up with $56 of federal unemployment tax. You'll observe here that there is a Section B, and if you do not answer yes to all of the questions in Part 2 up above, then you would need to complete for Section B instead, and you will observe that the tax rates under Section B are significantly higher than they are under Section A. So if you don't pay into the state unemployment fund, well, the IRS is going to make you pay a whole lot more down here. So it's just best to get your clients together and paying into their state fund because it's probably less that way. Now we're going to take the total taxes from page 1 of Schedule H, add those to the $56 calculated on line 16 of Schedule H, and we get the total amount on line 26 that will carry over and be entered on page 2 of the Form 1040. So the amount of tax to enter on page 2 of Form 1040 for Sylvia would be $2,392. We would go over to line 59. We would check box B, and on line 59 we would enter $2,392 for Sylvia. I should point out now that if a filer has a household employee, it's obviously going to have a significant impact on the amount of income tax that they need to include on their tax return. And if your client ends up owing more than $1,000 when they file their personal return because they had a household employee, it could throw them into a situation where they have to pay estimated tax penalties for underpayment of estimated tax. So if this is the case, your client may be required to pay a penalty, and the way out of the penalty is to pay estimated taxes. Another way to avoid the penalty is for the taxpayer to increase the amount of federal income tax withholding from their W-2 where they work. So for example, if you have a job, at your job you could go to your employer and tell your employer to hold out more tax. And by holding out more tax, that additional withholding could offset the tax that you owe on your household employee. Line 59C is the next line that we're looking at. It's right here, Form 5405. And what is that about? Well, Form 5405 is the form used to calculate and also to repay the first-time homebuyer credit. So in order to understand how that credit works, you're going to have to learn a little bit about the first-time homebuyer credit first. There were essentially a total of 3 first-time homebuyer credits that came into existence. The first homebuyer credit came into being in 2008, and that credit was more like a loan. The credit was a maximum of $7,500, and if you purchased your first home in 2008, you may have qualified for and received that credit. Well, the credit for homes purchased in 2008 is a loan, and it has to be repaid beginning in tax year 2010. The loan is repaid at a rate of $500 per year. But there were 2 other first-time homebuyer credits that came into effect. One in 2009 and another one later in 2009. And those 2 credits were not loans and do not have to be paid back over time. However, for any of the 3 first-time homebuyer credits, the rule is the same in that you have to continuously own that home and occupy that home for a minimum amount of time. If you fail to live in your home for the required minimum amount of time, you may be required to repay your credit no matter which of the 3 homebuyer credits you claimed. So let's look first at the annual repayment amount for a home that was purchased in 2008. If you claimed the credit for a home you bought in 2008, you must generally begin repaying it on your 2010 return. Beginning in 2010, you must complete Form 5405 and enter $500 on Form 1040, line 59, and check box C. So line 59, check box C, then enter $500 each year beginning in 2010. Now, you may be required to repay more than $500 for 2010 if you claimed a homebuyer credit for a home you bought in 2008 and then you sold the home in 2010 or the home stopped being your main home in 2010. Next is repayment of the homebuyer credit claimed for 2008 or 2009. You must repay all or some of the homebuyer credit you claimed for 2008 or 2009 if you disposed of or ceased using as your main home the home for which you claimed the credit, and any of the following situations apply. You sold, including through foreclosure or repossession, the home to a person who is not related to you, and you had a gain on the sale. If you sell the home to someone who is not related to you, the repayment in the year of the sale is limited to the amount of gain on the sale. The amount of the credit in excess of the gain does not have to be repaid. Or you sold the home to a related person, or you converted the entire home to a rental or business use, or you still own the home but no longer use it as your main home, or your home was destroyed, condemned, or disposed of under a threat of condemnation, and you do not plan to acquire a new home within 2 years of the event. To determine how much of your credit you must repay, complete Form 5405 Gain or Loss Worksheet as shown next. This particular worksheet for the 5405 form appears in the instructions for the form. And essentially what it asks you to do is enter the selling price of the home, the selling expenses associated with the home, and get the amount realized from the sale of the home. You then look at the adjusted basis of the home, and if the adjusted basis of the home is less than the amount realized from the sale, you're going to have a recapture amount. Now, no repayment of the first-time homebuyer credit is required if the following exceptions apply. Your home ceased to be your main home because you or your spouse, if married, was a member of the Uniformed Services or Foreign Service or an employee of the intelligence community, and you or your spouse received government orders to serve on qualified official extended duty service. Or you sold, including through foreclosure or repossession, the home to a person who is not related to you, and you did not have a gain on the sale. Use Form 5405 Gain or Loss Worksheet to determine if you have a gain. When figuring the gain, reduce the adjusted basis of the home by the amount of the credit. If you do not have a gain, you do not have to repay the credit. Or you transferred the home to your spouse or ex-spouse as a part of a divorce settlement. The responsibility for repayment of the credit is transferred to your spouse or ex-spouse. If none of the allowed exceptions apply and your spouse or ex-spouse sells the home or it ceases to be his or her main home during the 36-month period beginning on the purchase date, then he or she is the one that becomes responsible for repaying the credit. Or your home is destroyed, condemned, or disposed of under threat of condemnation. In this situation, you do not have to repay the credit if you purchase a new main home within 2 years of the event and you own and use it as your new main home during the remainder of the 36-month period. Or the taxpayer who claimed the credit died in 2010. No repayment of the credit is required of the deceased taxpayer. Or you die. But if you claimed the credit on a joint return and then you die, your surviving spouse would be required to repay his or her half of the credit if during the 36-month period beginning on the purchase date he or she disposes of the home or it ceases to be his or her main home and none of the allowed exceptions mentioned above applies. Now, how do you repay the homebuyer credit? If you received the 2008 or 2009 homebuyer credit when you purchased your home, you may have to recapture all or a portion of the amount that you received. The 2008 first-time homebuyer credit is intended to be repaid by the taxpayer over a period of 15 years at a rate of $500 per year beginning with tax year 2010. However, if your home ceases to be your main home before the 15-year period has elapsed, you must include all remaining annual installments as additional tax on the tax return for that year. Your home ceases to be your main home if you sell the home, convert the home to business or rental use, or the home is destroyed, condemned, or disposed of under the threat of condemnation. If you sell your home or otherwise stop using your home as your main home, you will need to file Form 5405 for the first-time homebuyer credit and repayment of the credit with your tax return. If you sell your home to a person who is not related to you, the recapture shall not exceed the amount of gain, if any, on such sale. And here is an example. Johnny sold too soon received $7,500 as a 2008 first-time homebuyer credit. He purchased his home in July of 2008 for $250,000. His adjusted basis in the home is $242,500. And he figures that by taking the $250,000 purchase price and subtracting out $7,500 for the first-time homebuyer credit. Johnny sold the home on August 3 of 2010 for $253,000. Expenses of the sale totaled $4,500. His net gain from the sale is figured as follows. He takes the purchase price of the home and subtracts out the homebuyer credit. That gives him an adjusted basis of $242,500. Next, he takes the selling price of the home and subtracts out the selling expenses. Then he takes the sales price of the home, subtracts out the selling expenses, and subtracts out the adjusted basis. That gives him a gain on the sale of $6,000. The worksheet provided for calculating the gain works a little bit differently, but ultimately gives you the same answer. We start with the selling price of the home, subtract out the selling expenses to get the amount realized from the sale. We then go to the cost of the home, subtract out the amount of credit claimed, and then we subtract that total, $242,500, from the amount realized from the sale. Either way, we get the same $6,000, and that $6,000 carries to Form 1040 and then is entered on line 59. So here is Johnny Sold Too Soon's completed Form 5405. He enters the date of the sale. He enters the amount of credit he claimed. He enters the gain on the sale. He checks box C for Form 5405 and enters $6,000. He obviously has other taxes due. You can't see where that computation is coming from, but his $6,000 adds to other taxes he owes, and the total tax on line 60 is now $7,183. Now, what happens if you owe money with your tax return? Well, obviously, the government wants you to pay what you owe, and they have a payment voucher for you to do that with. Form 1040V is a statement that you send in with your check or money order for payment of any balance due on the amount you owe line of your Form 1040. And the amount you owe line is right here, line 76. So whatever amount you show on line 76, you need to pay it, and one of the ways that you can pay that is by mailing a check in with Form 1040V. Now, using Form 1040V allows the IRS to process your payment more accurately and more efficiently. The IRS strongly encourages you to use Form 1040V, but there is no penalty if you do not. Next up is the injured spouse allocation. Now, sometimes it happens that you would be filing a joint tax return with another person, your spouse, and your spouse has a tax liability with the federal government that is causing you to be injured. How are you injured? Well, on your personal return, if it weren't for the fact that your spouse owed money, you'd have a refund coming. But the IRS doesn't want to give you that refund because your spouse's name is appearing on your return. Your spouse has a garnishment order against their refund, and essentially the IRS takes your refund in payment of your spouse's debt. So Form 8379 is filed by one spouse, that is the injured spouse, on a jointly filed tax return when the joint overpayment was or is expected to be applied or offset to a past due obligation of the other spouse. By filing Form 8379, the injured spouse may be able to get back his or her share of the joint refund. You may be an injured spouse if you file a joint return on Form 1040 and all or part of the tax refund overpayment was or is expected to be applied or offset against a debt of your spouse's legally enforceable past due federal tax account, state income tax account, child or spousal support account, or federal non-tax debt such as a student loan. How do you fill out the form? Well, you complete Part 1 of the form to determine if you are an injured spouse. You complete Part 2 of the form to tell the IRS which tax year you are requesting relief for, and you complete Part 3 of the form to allocate income and deductions between you and your spouse. You can file Form 8379 with your tax return, or you can file it separately from your return. You should allow 8 to 14 weeks for IRS to process this form. Now, we did not put an image of Form 8379 in your student manual, but I did still want to review it with you real brief. Here is Part 1, should you file the form. And this is actually where the IRS finds the greatest number of errors. They find that people are filing the form when they're not required to, such as they're filing an injured spouse form when they're not even filing a joint return, and maybe we're never even married. really the form is used for a very specific situation, and that is if you were to file a tax return without your spouse, you would have a refund in your own name. But because you are filing a tax return with your spouse and your spouse owes the government money, the government is going to take your refund to pay their debt, and that's not very fair. So the IRS says, okay, we'll help fix this problem. We'll allow you to file this injured spouse form, and you use the injured spouse form to tell us how much of the income shown on the return is allocable to you, and how many of the deductions on the return are allocable to you, and how much of the refund shown on that tax return is allocable to you. And if you can show that a portion or all of the refund shown on your joint tax return is completely attributable to you, then we'll still send it to you. So you go through these questions on Form 8379 to determine if you're entitled to file the form. Down at the bottom of page 1 it says, information about the joint return for which this form is filed. Enter the following information exactly as it is shown on the tax return, and then it asks a few additional questions. Part 3 of the form is where you do the allocation, and you enter wages, all other income. We enter adjustments, standard deduction, the number of exemptions, and credits, and you have to divide those between the taxpayer and the spouse. Column A shows the total combined amount of each of those lines on the joint return. Column B shows the amount of income and deduction to allocate to the injured spouse, and column C is the amount that is allocated to the other spouse. Ultimately, you have to show that a portion of the refund is due to the injured spouse. If all of the refund is allocable to the other spouse who has the debt, then the form should not be filed. There is also a place in Part 4 to sign the form, but you only complete this part if you are filing Form 8379 by itself and not mailing it with the return. Now, I also wanted to point out to you another form. This form is 8857, and I frequently see tax preparers get confused about the difference between a request for innocent spouse relief and injured spouse. Injured spouse is a form that is filed when you are filing a joint return with a person you are currently married to, and that return has a refund due to you, but you're afraid the IRS is going to take your refund, or the IRS has already taken your refund from you because the person whom you've signed the joint return with owes money. Different, completely different, is the request for innocent spouse relief. And the request for innocent spouse relief is filed when the IRS is coming after you for a debt that you attribute to your spouse. So it's not a garnishment of a refund on a joint return with the spouse who owes money, but rather a situation where in some prior year you filed a joint return with your spouse and that return was inaccurate. Or even if it was accurate, it showed tax was due and it was never paid. And now the IRS is coming after you for tax that you believe is owed by your spouse. And so you would file an innocent spouse relief form in those situations. I'm not going to explain to you how the innocent spouse form works or how to fill it out. I did just want to show it to you so that you understand that there are two different forms out there that seem to have a similar purpose, but they really are very different. Injured spouse is filed when you are filing a current year return with your spouse and you are afraid that a portion of your refund will be garnished because of your current year spouse's debt. Form 8857 is filed if in an earlier year you filed a joint return with your spouse or ex-spouse that showed a tax debt and that debt has been unpaid, but you believe your spouse and not you is responsible for that debt. The next form we're going to take a look at is the Tax Information Authorization Form. Form 8821 authorizes any individual, corporation, firm, organization, or partnership you designate to inspect and or receive your confidential information in any office of the IRS for the type of tax and the years or periods you list on Form 8821. You may file your own tax information authorization without using Form 8821, but it must include all information that is requested on the form. So this form is essentially used if you need to get a signature from your tax client that authorizes you to collect information from the IRS for them on their behalf. It is not a power of attorney, and it has limited privileges that go with it, mainly the release of information. So you're essentially going to the IRS and you're saying, hey, IRS, I'd like a copy of their tax return from an earlier year, or I'd like a detailed transcript of correspondence that's been going on between you and my tax client. And by signing this form, your client is giving permission for the IRS to deliver that information to you. Now, you do not use Form 8821 as a power of attorney. Power of attorney is a separate document. So Form 8821 does not authorize your appointee to advocate your position with respect to federal tax laws, or to execute waivers, consents, or closing agreements, or to otherwise represent you before the IRS. If you want to authorize an individual to represent you, you must use Form 2848, Power of Attorney and Declaration of Representative. Now, the thing with a Power of Attorney form is that in order to have a power of attorney for your tax client, you generally must be the person who prepared the tax return at issue, or you must be an enrolled agent, CPA, or an attorney. If you are a tax preparer who is not the person who prepared the tax return and you are not an enrolled agent, CPA, or an attorney, generally you cannot have a Form 2848 which would allow you to represent your client. The most that you could do is collect information from the IRS on behalf of your client, and in order to do that, the client would sign 8821. The next topic is estimated taxes. Who must pay estimated taxes? Well, in most cases, you must make estimated tax payments in 2010 if you expect to owe at least $1,000 in tax for 2010 after subtracting your withholdings and credits, and you expect your withholding and credits to be less than the smaller of 90% of the tax shown on your 2010 return, or 100% of the tax shown on your 2009 return. Note, though, that if your adjusted gross income is more than $150,000, or half that amount for a married filing separate for 2010, your income tax withholding must be 110% of your 2009 tax after credits. Estimated tax rules apply to U.S. citizens and resident aliens, as well as residents of Puerto Rico, the Virgin Islands, Guam, the Commonwealth of the Northern Mariana Islands, American Samoa, and also to non-resident aliens who would generally use Form 1040 ESNR. Are there any exceptions to paying estimated tax? Well, yes, there is. You do not have to pay 2010 estimated tax if you were a U.S. citizen or resident alien for all of 2009 and you had no tax liability for the full 12-month 2009 tax year. So what does that mean? Well, let's go over and look at a 1040, and this is the 1040 for 2010, of course. But what we're looking at is, was there a number on line 60 for 2009? If there was no number, or if the amount on line 60 for 2009 was 0, then you are not required to pay estimated taxes in 2010, no matter how much money you make. But if you had a tax liability shown on line 60, then you are required to pay in 100% of your prior year liability, or 90% of the current year liability, to avoid an underestimated tax penalty if the amount owed for 2010 is more than $1,000. Now, what about withholdings? How do they work? Well, if you are an employee, you may be able to avoid having to pay estimated taxes by having your employer withhold income taxes from your pay. Even if you do not have income taxes withheld evenly throughout the year, you will avoid the penalty for underpayment of tax by having the minimum required amount withheld from your pay by the end of the year. I'm going to show you a couple of examples in just a moment. But first I wanted to give you the password to open the Session 11 homework answer key, and that password is Tahiti. T-A-H-I-T-I. So here is an illustration on how the estimated tax works, and a way that you could actually underpay throughout the year, but then do kind of a catch-up through withholdings on your job. Here's the illustration. Sam works for ABC Company, and during the year he was short on cash. So Sam asked his employer to stop withholding taxes from his pay. Beginning in October, Sam asked his employer to withhold the additional taxes from his pay. So long as Sam has enough tax withheld from his pay by the end of the year, he will not owe an underpayment penalty, even though his withholding was not equal throughout the year. In effect, Sam has received an interest-free loan. He has had the use of the government's money all year and owes no additional tax because of it. Well, let's see if I can make some sense of this for you. So I've opened up a 1040 here, and I just wanted to kind of play around with some numbers so you can really understand what it is that causes a person to have to pay estimated tax and some of the little maneuverings that they might be able to do in a year that will allow them to not pay estimated taxes. And then also what happens when they don't pay their estimated taxes. So I'm actually going to go to page 2 of the Form 1040. And let's suppose that on the 1040 form, we have a client who during the year 2009 had a tax liability showing on line 60 of $5,000. So if on the 2009 return your client had a tax liability of $5,000, then they need to have enough withholding from their income during 2010, or they will have to pay an estimated tax penalty. So let's see how they would go about doing that. Let's suppose in 2010 they're going to show a tax liability on line 60 of $6,000. And during the year, though, they only had $4,000 of withholding. So what ultimately would happen is on line 72 they would have $4,000, and on line 76 they would owe $2,000. Well, in this scenario, you're going to take $6,000 minus $4,000. You get $2,000 of balance due. The question is, does this person owe an underpayment of estimated tax penalty? And the answer would be yes, because if the 2009 tax is $5,000, they did not pay in 100% of the prior year liability, nor have they paid in 90% of the 2010 liability. So they will owe an estimated tax penalty. So how could they avoid this problem? Well, to avoid the problem of owing estimated tax, the filer needs to pay in at least 100% of the prior year liability. And if he were to do that, then he would only owe $1,000 when he files. And if he only owes $1,000, he would not owe a penalty for two reasons. The first reason being he paid in 100% of the prior year liability, and the second reason being that his underpayment is only $1,000, and you only owe an estimated tax penalty when the underpayment goes over $1,000. So let's kind of rearrange our problem a little bit, and let's just suppose that this year's liability is $10,000, and again he had only $5,000 withheld, so that the amount shown on line 76 is going to go up to $5,000. Well, if the 2009 liability is $5,000, and he pays in $5,000 in 2010, then even though he owes $5,000, when he files his return, he will not owe an underpayment of estimated tax penalty, because line 61 on 2010 is 100% of what it was in 2009. Now, if his income, though, is over $150,000, then the rule is that he would have to pay in 110% of the amount shown in 2009, and 110% of $5,000 is, of course, $5,500. So this is kind of a lot of rambling with a lot of numbers, but I just wanted to try and show you or explain to you how the estimated tax can be maneuvered somewhat. Now, there are some special rules for farmers and fishermen. If at least 2/3 of your gross income is from farming or fishing, you may do one of the following. You do not have to pay estimated tax if you file your 2010 tax return and pay all of the tax due by March 1st, 2011. So essentially what this is saying is you don't have to pay any estimated tax payments at all in 2010 if you file your 2010 return by March 1st and pay all of the tax you owe with it, if you're a farmer or a fisherman. Another special rule for farmers and fishermen, rule number 2. You do not have to pay estimated tax if you expect your 2010 income tax withholding to be at least 66 2/3% of the total tax to be shown on your 2010 return, or 100% of the total tax shown on your 2009 return. And if you must pay estimated tax and you are a farmer or a fisherman, you are required to make one estimated tax payment, that is your required annual payment, by January 18, 2011, using the special rules to figure the amount of the payment. If you're not a farmer or a fisherman, this is the schedule for how you would have to make your estimated tax payments. The first payment is due April 15th. Then 2 months later, on June 15th, your second payment is due. 3 months later, on September 15th, your third payment is due, and your fourth payment for the year is due on January 18, 2011. But if you are a farmer or fisherman where at least 2/3 of your income came from farming or fishing, then you do not need to make payments in the first, second, or third quarter. Instead, you could make all of your payment at one time in one lump sum on January 18, 2011. Alternatively, you don't even make that payment, and instead you file your tax return by March 1st and pay all the money you owe with that return. Note, as usual, that if the due date for an estimated tax payment falls on a Saturday, Sunday, or legal holiday, the payment will be on time if you make it on the next day that it is not a Saturday, Sunday, or legal holiday. In 2011, January 15th was a Saturday, and Monday, January 17th, was a holiday, so the January 15 payment was due by January 18, 2011. Caution! Many taxpayers who pay quarterly taxes do not remember to keep accurate records of the dates and amounts of their quarterly payments, and inexperienced tax preparers can also apply a quarterly payment to the wrong year. Here is an example of what I mean. Janice is 70 years old, and during 2010 she made the following estimated tax payments. On January 5, 2010, she paid $500. Then on April 10th of 2010, she paid $550. On June 15th, she paid $550. September 6th, $550. And then on January 10th of 2011, she paid another $550. Well, watch out for that January payment. The January 2010 payment is actually the final estimated tax payment for the tax year 2009. And the total 2010 payments should include April, June, and September payments from 2010 and the January 2011 payment. Here's another example. Mr. H made estimated payments during 2010. He wrote the date and amount of each payment in his check register. In April 2011, Mr. H asks you to prepare his tax return. He tells you he made 4 payments of $400 to the IRS. Watch out! If Mr. H did not provide the correct information on his payments, the amount you enter on his Form 1040 will not be correct. Whenever possible, you should ask the client to provide documentation on the amount and date of each estimated tax payment made. Let's take a look at the 1040 real quick and see where those estimated amounts are shown. So line 62 of the Form 1040 is where you enter the amount of estimated tax payment that was made during the year. There's also a provision on line 62. You can see right here it says, and the amount that was applied from your 2009 tax return. So if you have a 2009 refund, you do have the ability to elect to forward the 2009 or apply the 2009 refund to your 2010 estimated taxes. So you use line 62 to show the amount of refund applied from 2009 as well as any estimated payments made during 2010. The total amount is entered on line 62. Well, the thing is that if you enter the wrong amount on line 62, the IRS will know it. And this is an incredibly common problem. The reason it's common is that the tax preparer is not paying attention. And what happens is tax clients, they bring in their canceled checks and they hand them to you and they say, yeah, these are the checks I have for estimated tax payments I made during the year. And the preparer just totals them up and enters the amount on the tax return. But you really have to pay attention to what you're doing. If your client hands you a canceled check dated January 5, 2010, and you're preparing a 2010 return, well, that check probably does not apply to the 2010 return. Instead, you should be asking for a 2011 January check and applying that amount or adding that amount to the tax return as an estimated tax payment. Now, it is very common for clients to not remember exactly how much estimated tax they paid. So what do you do if your client forgets? Well, you can call the IRS at 1-800-829-1040 for a detailed record of your account information, including the amount and date of each estimated payment received. How do I accurately calculate the amount of estimated tax that I need to pay? Well, calculating the correct payment amount can be tricky. The IRS provides an estimated tax worksheet which can be helpful. But I don't really care for the estimated tax worksheet at all because it doesn't account for variables. It doesn't account for what will change in your client's tax life in the next year. So when I am figuring estimated tax for my client, I use this system instead. You figure your approximate income and deductions for the coming year. So if you're looking forward to how much estimated tax your client should pay in 2011 for the 2011 tax return, then you really need to be looking forward to how much income and deductions your client will have for the tax year 2011. You then calculate the expected tax liability after projecting income and deductions for the current year. You then subtract the amount of tax you expect to have withheld from your pay by the end of the year. If the difference between your anticipated tax liability and your anticipated withholding is less than $1,000, you do not need to make estimated tax payments. If the difference is at least $1,000, divide that difference by 4, and this is the amount of estimated tax you should pay for each quarter. So going over to the 1040 form, let's just suppose that I am running up a dummy tax return. I'm looking forward to what I think my tax situation will look like in 2011. And for 2011, I project that the amount of tax I will owe on line 60 is $7,500, and that the amount of withholding I'm going to have on line 61 is only $4,000. So that when I file my return for 2011, I expect that I'm going to owe $3,500. Well, if I expect I'm going to owe $3,500 for 2011, I'm going to take $3,500, divide that by 4, and I get $875. $875 is the amount I should pay for each quarter during 2011 to avoid an underpayment penalty for 2011. So how do I go about paying estimated taxes? Well, there are actually 5 different ways to pay your estimated tax. The first is to credit an overpayment on your 2010 return to your 2011 estimated tax. So let's just suppose that my tax for 2010 is $7,500 and that I've had $10,000 withheld and that I'm going to have a $2,500 refund for 2010. Let's also suppose that looking forward to 2011, I'm predicting that I'm going to have a 2011 balance due and that I'm not going to have enough tax withheld in 2011 I'm going to owe. So what can I do about that? Well, I can make an election to have my refund from 2010 applied forward to 2011, and I do that on line 75. Let's just suppose that I would like to have $1,000 of my current year 2010 refund applied to 2011. If I do that, the IRS will issue me a refund for 2010 of only $1,500, and $1,000 will be applied forward to my 2011 tax bill. And of course, when I prepare my 2011 return, I would enter that $1,000 on line 62 as an amount that had been applied for my 2010 return. So another way to pay estimated tax is by sending a check or money order in with a payment voucher called Form 1040-ES. And I have a 1040-ES right here for you to see. This particular payment voucher is for the first quarter due April 15th. The payment vouchers are numbered. The payment voucher for the second quarter is due on June 15th, and it would be labeled number 2. The third quarter is due on September 15th, and the fourth quarter is due on January 15th. Another way to pay your estimated taxes is to use the Electronic Federal Tax Payment System, or EFTPS. You must enroll online in the system, and it really is a marvelous system. You go to the website, you create an account for yourself, and then what you can do is you can tell the IRS to go to your bank account and actually just take the money straight from your bank account. Now, it does make paying taxes very, very simple and quick. There's no need to mail a check off or pay for postage or wonder if the IRS got your money. It's all very streamlined, but it does require setting up an account. A third way is to pay by electronic funds withdrawal if you are electronically filing. This happens at the same time you file your tax return electronically. The third way is to pay by credit card using a pay-by-phone system or through the Internet. You can use American Express, Discover, MasterCard, or Visa to make your payments, but a convenience charge is charged by the following service providers. And essentially the reason for this is that when you go to a store and you use your credit card, the store will charge your credit card for the amount of your purchase. But ultimately, the store does not receive the amount of your purchase. They're going to receive something less than that because they have to pay a fee to the credit card company. Well, when you go to pay your tax bill, the IRS is not willing to pay that fee for you. And so when you use one of these credit card service providers, the fee that they normally charge a vendor is going to be charged to you instead. And it can be 1 or 2%, so you got to think twice about whether or not you really want to do it that way. So what happens if I underpay my estimated tax? Well, in general, you may owe a penalty for underpayment of estimated tax if you did not pay the smaller of 90% of the tax shown on your 2010 return or 100% of the tax shown on your 2009 return. That amount increases to 110% of your 2009 tax if your 2010 adjusted gross income is more than $150,000 or more than $75,000 if you are married filing separate. So how do you figure the penalty? You may have to pay an underpayment penalty even if you owe less than $1,000 with your return. The penalty is figured separately for each quarterly payment due date. Therefore, you may owe the penalty for an earlier due date even if you paid enough tax later to make up for the earlier underpayment. This is true even if you are due a refund when you file your return. So let's look at an example of how that penalty might work. Let's suppose you prepare your tax return and you show that you have a tax liability on line 60 of $3,000 and that during the year you paid in $4,000 of estimated tax. And let's suppose that you paid the estimated tax all with one check on January 18, 2011 and that you are not a farmer or a fisherman. Well, the reality is that you should have paid in your estimated tax payments in equal amounts throughout the year. And since you did not pay them in equal amounts throughout the year, the IRS can still assess an underpayment penalty against you, even though you have a refund. So essentially, you are supposed to pay each estimated tax payment on time each quarter, and if you fail to do so, you can still be assessed a penalty. There are some exceptions to that penalty. You will not have to pay the penalty if either one or two applies. Number one, you had no tax liability for 2009, or you were a U.S. citizen or resident for the entire year, and your 2009 tax return was or would have been had you been required to file for a full 12-month period. Or number two, the tax shown on your 2010 return minus the amount of tax you paid through withholding is less than $1,000. So let's look at an example of what we mean by that. Let's suppose that you figure your tax bill for the year at $3,000 and you had $2,800 of tax withheld on your W-2. Well, you go down to line 76 and you'd show that you owe $200. Well, since $200 is less than $1,000, you do not owe a penalty. Also, the total tax you paid during the year came in the form of withholding. And what that means is that it doesn't really matter when in the year you had that withholding. You could have had all of the withholding occur in the final 3 days of the year, and you still would not owe an underpayment of estimated tax penalty. Waiver of the penalty. You may request a waiver of some or all of the penalty if you can show the IRS that the underpayment was due to a casualty, disaster, or other unusual circumstance, and it would be inequitable to impose the penalty. Or, in 2009 or 2010, you retired after age 62 or became disabled, and your underpayment was due to reasonable cause. To request a waiver, you should complete Form 2210, Underpayment of Estimated Tax by Individuals, Estates, and Trusts. You should check box A or B in Part 2. And if you checked box A, complete only page 1. But if you check box B, write the amount you want waived in parentheses in the dotted line next to line 17. And then attach a pertinent document and a written statement to your return explaining the reasons you were unable to meet the estimated tax requirements and the time period for which you are requesting a waiver. So here is Form 2210, and in Part 1, you figure whether or not you need to file the form. You start with this line right here where it says complete lines 1 through 7 below. Is line 7 less than $1,000? Well, line 7 is where you figure if you owe money. If you owe less than $1,000, you do not owe a penalty. If you owe more than $1,000, then you do. So here is Form 2210. I am not going to read it out to you. I'll let you explore it a little bit on your own. It is a rather complicated form and really above the skills of most first-year preparers, more advanced skill. Let's move on to the next page of the manual. Special rules for farmers and fishermen again. If you meet both of the following tests, you do not owe a penalty for underpaying your 2010 estimated tax. Test number 1. Your gross income from farming and fishing is at least 2/3 of your annual gross income from all sources for 2009 or 2010, and you filed Form 1040 or 1041 and paid the entire tax due by March 1st, 2011. So how do you calculate your penalty? Calculate your penalty for underpayment of tax by completing Form 2210. If you do not complete Form 2210, the IRS will do it for you and send you a bill for the additional tax owed. You may be required to pay additional penalties and taxes if you do not pay your underpayment penalty by the due date of your tax return. On to the next topic of the day, paying the amount you owe. Because of the current economic recession, many taxpayers will not be able to pay amounts owed with their 2010 tax returns. The IRS offers taxpayers the opportunity to enter into an installment agreement or partial payment installment agreement. Tax preparers should be aware of the two plans and the criteria for each. Firstly, we're going to look at the Installment Agreement Request Form 9465. If you cannot pay the full amount due with your return, you can ask to make monthly installment payments for the full or partial amount. Interest and late payment penalties are charged by the IRS until such time as the amount owed is paid in full. Also, a user fee applies if the IRS accepts the installment agreement. To request an installment agreement, use Form 9465. You should receive response to your request within 30 days. But if you file your return after March 31, it may take longer for a reply. Filing Form 9465 can reduce or eliminate your late filing penalties. You are better off filing Form 9465 and mailing it with your timely filed tax return than you are if you either don't file at all or you file for an extension and don't pay your tax. Guaranteed availability of installment agreement. The IRS must agree to accept the full payment of your tax liability in installments if, as of the due date you offer to enter into the agreement, your total taxes, not counting interest, penalties, additions to tax, or additional amounts, do not exceed $10,000. And in the last 5 years, you and your spouse, if the liability relates to a joint return, have not failed to pay any tax shown on any such return or entered into an installment agreement for the payment of any income tax. You show you cannot pay your income tax in full when due. The tax will be paid within 3 years, and you agree to comply with the tax laws while your agreement is in effect. Here is the Installment Agreement Request Form. It's a pretty basic, simple form. The form asks for the name and address of the filers. It asks for contact phone numbers so the IRS can call you. It asks for the name of your financial institution and the name of your employer. If you wish, you can have your payments through the plan directly taken from your bank account. If you have the payments directly withdrawn from your bank account, the amount of interest you have to pay is reduced. If you elect to have electronic funds withdrawal from your checking account, there can be some reduced fees that apply. Once the IRS agrees to set up an installment plan for you, you can expect to receive a monthly bill. You must make each payment on time or the plan will be rescinded. Making installment payments. In addition to paying by check or money order, you can use a credit or debit card or EFTPS to make installment agreement payments. Payment methods. You can make your payments by check, money order, credit card, or one of the other methods shown next. The fee for each payment method is as follows. If you go with check, money order, or credit card, the applicable fee is $105. If you choose the electronic funds withdrawal, then the fee is cut to just $52. And if you elect to do a payroll deduction installment agreement, then the fee is $105. You may qualify to pay a reduced fee of $43 if your income is below a certain level. The IRS will let you know whether you qualify for the reduced fee. If the IRS does not say you qualify for the reduced fee, you can request the reduced fee by using Form 13844, Application for a Reduced User Fee for Installment Agreements. There is also something called an online payment agreement application. You may be able to apply online for a payment agreement if you owe federal tax, interest, and penalties. If you have received a balance due notice from the IRS and you cannot pay it in full, you can request a payment agreement. The OPA application allows you or your authorized representative to self-qualify for and apply for a payment agreement, receive notification of approval, and arrange a payment schedule. To use the OPA application, you must have filed all required tax returns. You should also have the following information available: the balance due notice from the IRS, the Social Security number or individual taxpayer identification number, and the personal identification number, which can be established online using the caller identification number from the balance due notice. For more information about applying for an online payment agreement, go to the URL shown here in your manual. Next up is amended tax returns and claims for refunds. Now, you might have been wondering what happens if you make a mistake on your tax return. Is there any way to fix that? Well, the answer is yes, there is. If you made an error on your tax return, you can file Form 1040-X to correct the error and receive a refund or pay any additional tax owed. Caution, an amended federal 1040 individual tax return cannot be filed electronically at this time. However, the IRS does currently accept current year 1065 and 1120 series amended returns electronically. So if you file a partnership or a corporate return, an amended return, you can do so electronically. But if you are filing an individual return amended, you have to do so paper. So also, I wanted to point out amending your state tax return. If you file an amended federal return, you may also be required to file an amended tax return with your state. In certain states, it is possible to electronically file an amended return, and in other states, it is not. So where do you file, or when do you file Form 1040-X? Well, you file Form 1040-X only after you have filed your original return. Generally, you must file Form 1040-X for a refund or credit within 3 years, including extensions, after the date you filed your original return, or within 2 years after the date you paid tax, whichever is later. A return filed early is considered to be filed on the due date, generally April 15. However, if you had an extension to file, for example, October 15, but you filed earlier than October 15, your return is considered to be filed on the actual date it is filed. So, for example, if you had an extension until October 15, but you filed your return on September 1st, then your statute of limitation clock begins on September 1st. But if you file your tax return on February 15, the statute of limitation clock does not begin until April 15. I should also point out that the Form 1040-X amended form was revised in December of 2010. It does look different for 2010 than it did in earlier years. Federal Form 1040-X, you should correct your return and file this form if you find that you did not report some income, or you claimed deductions or credit that you should not have claimed, or you did not claim deductions or credits that you should have claimed, or you should have claimed a different filing status. Generally, once you have filed a joint return, however, you cannot choose to file separately after the due date of the return. Here is 1040-X. Let's see how it works. You enter your name, your spouse's name, and your address. You select the filing status on the amended return. In column A, you enter the amount of income and deduction items shown on the original return. In column C, you will enter the amount of income and deduction items shown on the corrected return. And in column B, you report the net difference between those amounts. The form is divided into an income deduction section, a tax liability section, and a payment section. Then in the lower part of page 1 of the form, you figure the amount of refund or the amount that you owe with the amended return. Part 1 of page 2 of the Form 1040-X is completed only if you are increasing or decreasing the number of exemptions that you are claiming on your tax return. If you are increasing or decreasing the number of exemptions, they want to know the names of the persons who you are including or removing from your tax return. If you filed your original return and did not check the presidential campaign box, this is your opportunity to do so. And in Part 3 of the form, you enter or describe the reason why you were amending the return, and then there is a place to sign. So how do you file your amended return? To file an amended return, you must first prepare a new corrected Form 1040 and attach all the correct schedules and forms. When you have finished preparing your corrected tax return, complete Form 1040X using the information from the corrected form. The IRS will compare your new return to the one that you originally filed. Attach Form 1040X on top of your corrected Form 1040, as well as other required forms and schedules. Sign page 1 of Form 1040X. It is not necessary to sign the Form 1040 that you are attaching, but be sure to sign the Form 1040X that you are filing. If you are requesting a refund from Form 1040X, expect it to take 3 months to be processed. If you owe additional tax with your return, pay the balance due with the amended return. You can also calculate and pay any penalties and interest owed on the balance due. If you do not include payments for penalties and interest with your return, the IRS will send you a letter assessing additional penalties or interest due. You will be required to pay these additional penalties and interest in most cases. Tax on investment income of certain minor children is the next topic of the day. To prevent wealthy individuals from avoiding tax by turning their investment income over to their minor children, the government created the Kiddie Tax. The Kiddie Tax is assessed against the investment income that exceeds $1,900 for a minor child who was under age 18 on the last day of the year, or certain children aged 18 on the last day of the year, and certain full-time students over age 18 and under age 24 at the end of the year. There are 2 different ways the Kiddie Tax can be assessed: by filing Form 8814, Parents' Election to report the child's interest and dividends, or by filing Form 8615 for tax for certain children who have investment income of more than $1,900. If you are the parent, you can elect to include your child's income on your return by filing Form 8814. If your child is filing his or her own tax return but needs to pay an additional tax because they had investment income, the child would attach Form 8615 to his or her return. So which parent's tax return do you use when you are calculating the tax on the investment income of minor children? Well, we look to the filing status or situation of the parents, and then the IRS determines which parent's return is used. So if the parents are married and live together and they file a joint return, then the parent's return to use is the joint return. If they file separate returns, you will use the return of the parent with the highest taxable income. If the parents are married and do not live together, and the custodial parent is married filing separate, you will use the return of the parent who has the greater taxable income. If the custodial parent is filing head of household, you will use the return of the parent who had custody for more than half the year. If the parents are divorced and the custodial parent has not remarried, you will use the return of the parent who had custody for more than half the year. If the custodial parent has remarried and the custodial parent and the step-parent file a joint return, then you would use the joint return of the custodial parents. If the custodial parent has remarried and the custodial and step-parent live together but file separately, then you will use the tax return of the parent or step-parent who has the greater taxable income. If the custodial parent has remarried and the custodial parent and the step-parent do not live together and file separately, you will go back to the rules for parents married and not living together, which is up here. If the parents never married but lived together all year, you will use the parent with greater taxable income. If the parents married but did not live together all year, you will use the parent with custody for more than half the year. And if the parent is widowed and has remarried, then you will use the rules for custodial parent remarried. So let's take a look at this Form 8814. If your child's interest and dividend income, including capital gain distributions, totals less than $9,500, you, if you are the parent, may be able to choose to include your child's investment income on your return. If you choose to report your child's investment income on your return, you should file Form 8814. If you choose to include your child's income on your return, your child's income will be taxed at your higher rate. So who can make the election? To make this election, you must be the parent of the child. If you and the other parent of the child do not file a joint return, you should refer to the chart above. which parent's return to use when calculating the tax on investment income of certain children. So which income can be reported on Form 8814? Your child's income must come from interest or dividends or Alaska Permanent Dividend Funds. The income cannot come in the form of sale of stock or other property, wages or other earnings, or any other form of income that is not interest or dividends. You can make the election to report your child's income on your return if all of the following conditions are met. Your child was under age 19 or under age 24 and a full-time student on January 1, 2011. Your child is required to file a return if you do not make the election. Your child had income only from interest or dividends. The dividend and interest income was less than $9,500. No estimated tax was paid under your child's Social Security number. No federal income tax was withheld from your child's interest or dividend income under the backup withholding rules. You are the parent whose return must be used when applying the special tax rules for children, and the child does not file a joint tax return. So here is an illustration. J.R. Ewing is reporting $50,000 of wage income. He is also electing to report interest income of $4,500 and ordinary dividend income of $1,000 earned by his dependent son, John. Complete Form 8814 and Form 1040 is shown here. On line 1A, we report the $4,500 of interest income received by John, and on line 2A, we enter the $1,000 of dividend income. The total income is $5,500. We now subtract out $1,900. $1,900 is comprised of two numbers. The first number is the $950 standard deduction that applies to a dependent, and the additional $950 at which that dependent will be taxed at a rate of 10%. The difference between $5,500 and $1,900 is the amount of additional income that the parent has for the year, in this case $3,600. $3,600 will carry to Form 1040 of the parent's tax return and get entered on line 21 as income. We can see J.R. Ewing, his Form 1040. We've entered Form 8814 and $3,600 and on line 21. Now, there is more calculations going on here, and it has to do with this extra $950 that you see right here. $950 is not taxed at all because that's John's standard deduction as a dependent. But there's another $950 that is taxed at a rate of 10%, and we figure that tax in Part 2 of Form 8814, and we show that we end up with $95 of tax. This tax is added to J.R. Ewing's tax. So on page 2 of J.R. Ewing's Form 1040, we check box A that Form 8814 is attached. We then go to the tax tables and figure out the amount of tax J.R. Ewing owes on $40,300. And to that tax, we add the $95 and enter the total on line 44, which is $6,358. Now we use the tax tables to calculate the tax on $40,300. We then add to that tax $95 and enter the total here. So why file Form 8814 in the first place? Well, there are disadvantages and advantages to filing the form, and you really need to pay attention to your client's particular situation before you just start blissfully putting numbers on this form, because you can really mess them up. So let's look at some advantages and reasons why you would file the form. Well, an advantage is that there's no need to file a separate tax return for the child, so you'd save the hassle and maybe the expense of preparing a separate return for the child. Also, the parent's investment income is increased, which could allow a larger investment interest deduction if the parents have such a deduction. Also, the ceiling for charitable contributions is increased. That could happen, although rarely it's an issue. And finally, the first $1,900 of the child's income is not taxable at the parent's taxable income rates, and this can reduce the state tax liability in states that base tax on federal taxable income. The disadvantages to using Form 8814 include that the parent will have a higher adjusted gross income, and having higher adjusted gross income can reduce deductions subject to AGI phase-outs. They can also reduce the Earned Income Credit, the Child Independent Care Credit, and Child Tax Credits. They may affect state tax for states that base their tax on federal AGI. Also, the child's income may be taxed at a higher rate than it would be on their own return, and your child may miss out on the following deductions: the higher standard deduction for blind, the penalty on an early withdrawal from a savings account, and itemized deductions such as the investment expense or charitable contributions. I would say the biggest disadvantage that we could run across is a reduction in the earned income credit. And a few years ago, our company had a client who came to us, and they had gone to another accounting firm in an earlier year. And the CPA in that firm had included the child's investment income on the parent's return. And in doing so, it forced the parent's investment income to go over $3,100. Well, the parents actually had low income, and if their investment income had been less than $3,100, they would have been entitled to the earned income credit. So the CPA who prepared that return basically didn't give them the earned income credit. Well, when that tax return came across our desk, we went, whoa, the parent elected to report the child's income. The parent lost out on the earned income credit as a result. That was a very good reason to amend, and we did, and we got that client a huge refund because we amended the return. So you do need to watch what you're doing when it comes to reporting the child's income on the parent's return, and make sure you're not costing that parent a bunch of money. Let's compare Form 8814 now to Form 8615. This form is used to calculate the tax for certain children who have investment income of more than $1,900. If a child's interest, dividends, and other investment income totals more than $1,900, part of that income may be taxed at the parent's tax rate instead of the child's tax rate. If the parent does not or cannot choose to include the child's income on the parent's return, you use Form 8615 to figure the child's tax, and then you attach the form to the child's return. And here is Form 8615. This is the form you use to figure the tax that the child owes at the parent's higher rate. It requires that you obtain information that is reflected on the tax return of the parent, including the tax rate that the parent is taxed at. So when must I file Form 8615? Form 8615 must be filed for a child if all of the following statements are true. The child's investment income was more than $1,900. The child is required to file a tax return for 2010. The child was either under age 18 at the end of the year or was age 18 at the end of the year and did not have earned income that was more than half of his or her support, or was a full-time student over age 18 and under age 24 at the end of the year and did not have earned income that was more than half of his or her support. And at least one of the child's parents was alive at the end of the year, and the child does not file a joint return for the year. Figuring Kiddie Tax. Follow these steps to compute the amount of Kiddie Tax owed. Refer to the chart on page 26 of this manual. Which parent's return to use when calculating the tax on investment income of certain minor children. Then figure the child's tax on Form 8615 using these steps. In Part 1, you figure the child's net investment income, including income from interest and dividends, as well as capital gains, Social Security, pension payments, certain kinds of trust income, and rental income. In Part 2, you figure a tentative tax on the net investment income based on the parent's tax rate, and in Part 3, you figure the child's tax. Well, at this point, I'd like us to move on and do a classwork assignment together. The classwork assignment involves preparation of an amended tax return for Mary Poppins. Do you remember Mary Poppins? We prepared a tax return for her in Session 10. And the tax return that we prepared for her for Session 10 is her original return. And, well, she's got some mistakes on it, and she needs to amend it. Mary did not claim her younger sister Laura as a dependent on her original return. And during the year, Mary paid more than half the cost of supporting her sister, Laura Poppins, who lived with her all year while she was attending college. Laura paid $2,000 for tuition and fees expenses that she incurred while in her third year of full-time studies. Mary's original return also failed to include income from a second job that she worked at for part of the year. Mary has the following additional W-2 income to report. Please prepare a corrected Form 1040 return for Mary and then prepare her Form 1040X. So at this point, please push pause, prepare Mary's amended tax return. And when you are finished preparing her amended return, please resume playback for a review of Mary's amended tax return. Okay, so let's do a review now of the classwork answer key, which involves amending Mary Poppins' tax return. And right now in front of you, I have the original return that was prepared for Mary Poppins in Session 10 as a part of Session 10's homework assignment. And if you recall, Mary had a single dependent at that time named Jane and $35,600 of wage income and $1,000 of dividend income. The first two changes to point out that are going to happen on Mary's amended return is we're going to be adding Laura as a dependent. And that will change the number of exemptions that Mary can claim from 2 up until 3. The other significant change is that there was an underreporting of wage income. Mary left off a W-2, and so we're going to need to increase the amount of wage income reported on line 7 by $3,500. On page 2 of Mary's 1040 return, we're going to be looking at the education credit that was entered on line 49 because Laura paid education expenses for attending college, but she is a dependent of Mary. Mary is the one who will claim the education expenses that were paid by Laura, and Mary will qualify to claim the American Opportunity Credit on the expenses that were paid by Laura for Laura's college education. So we're going to see an increase in the amount of credit claimed on line 49. We're also going to see an increase in the amount of refundable American Opportunity Credit shown up on line 66. So all in all, even though Mary underreported her income, my expectation is we're going to see this refund go up. So here is the answer key to the Session 12 classwork assignment for Mary Poppins. And as I've already described, increasing Mary's income and adding an additional dependent will change her tax situation significantly. Her AGI is increased. She is going to claim American Opportunity Credit on her sister's educational expenses, even though it was the sister rather than Mary that paid them. On Form 1040X, the starting point is to prepare a new and corrected Form 1040 for Mary Poppins, including any additional forms or schedules that are required. We then essentially line the two tax returns, the original 1040 and the amended 1040 or corrected 1040 next to each other. Pretty much on a table would be the way to do it in most cases. And then you compare, going back and forth across those forms, what is appearing on the original form, what is appearing on the corrected form, and what is the difference between those columns on each form. So on the 1040X, we have 3 columns. Column A is where we enter the amounts from the original return. Column C is where we enter the amounts from the corrected return. And column B is where we enter the difference between columns A and C. So let's begin by taking a look at the corrected return for Mary Poppins. And as you can see, we have Jane and Laura both listed as dependents now, and we have 3 exemption deductions. We have $39,100 of wage income. We still have that same $1,000 of dividend income, and Mary's adjusted gross income is now $40,100. Of course, that means we need to refigure her taxable income. We end up with taxable income for Mary of $20,750, and the tax that we calculate on that is $2,519. Her foreign tax credit remains unchanged, but her education credit has increased, and her retirement savings contribution credit has not changed. Her net tax after credits has dropped down to $729. We then move over to line 61 where we show federal withholding, and that was increased because her W-2 has $600 of federal withholding on it. So we're going to give her credit on the amended return for that additional withholding. We have the same making work pay credit, and we have an increased American Opportunity Credit. So total credits and withholdings are now $3,460. Her tax is just $729. So her amended return shows a refund of $2,731. But we do have to consider the amount of refund she received on her original return. So she's going to be entitled to a refund with the amended return that is the difference between the refund she already received with the original return and what she should have received if she had filed her return correctly to begin with. Now let's just take a look at her education tax credit form 8863. We can see that Laura Poppins has been added. The education credit has gone up by $2,000 as a result. And on page 2 of the education credit form, we show again the $2,400 of qualifying education expense and the amount of credit that she is qualifying for is $2,400. That is divided as 960 refundable and 1,440 non-refundable credit. Going back up to the 1040X, because this tax return is appearing in the answer key in the order it should be assembled with the 1040X on top. We show Mary Poppins' name. We show that her filing status is head of household. We then go on to show her adjusted gross income. The adjusted gross income on the corrected return is $40,100. On the original return, it was $3,500 less. So we enter $36,600 from the original return, and of course the difference is that W-2 amount of $3,500. We then show the change in exemptions, and the change in exemptions on line 4 is the result of adding the dependent Laura. So the original exemption deduction was $7,300. The new exemption deduction is $10,950. The change is the equivalent of a single exemption deduction, which is $3,650. We end up with taxable income on the original return of $20,900, a correct amount of taxable income of $20,750. And the taxable income actually went down because we added a dependent. So we had a $3,500 increase in wage, but we had a $3,650 increase in deduction. So the net difference in taxable income is $150. Moving on to the tax liability amount has actually gone down, again because the taxable income went down. And then we have credits. The credits have gone up. The original credit was $590, and that was a combination of the American Opportunity Credit, the foreign tax credit, and the retirement investment savings credit. On the original return, those three credits totaled $590. On the corrected return, those three credits now total $1,790, a difference of $1,200. So the total tax has dropped from $1,951 on the original return down to $729 on the amended return, a difference of $1,222. Next, we look to the federal withholdings. The original return showed $1,500 of withholding, but the corrected return shows $2,100 of withholding, and the difference is that $600 that appears in box 2 of the missed W-2. Are we claiming any refundable credits? Yes, we are. We're claiming a refundable credit with Schedule M, which is the Making Work Pay credit. We're also claiming the American Opportunity Credit as a refundable credit, so we've checked both those boxes. And we end up entering refundable credit amounts of $560 on the original return, $1,360 on the corrected return, and a difference of $800. Now, on the original return, Mary received a refund of $109. Her actual refund should have been higher than that. The difference between what she should have received and did receive is $2,622. That is the amount of refund that she can expect to receive. Just a reminder, paper returns do need to be signed, so Mary does need to sign this paper return. Mary will sign her paper return at the bottom, and page 2 is where we provide a description. So moving over to page 2, we see that we have changed the number of exemptions. Remember, the original return had one exemption for Mary, and that is not changed. One for herself on the original return, one for herself on the corrected return. The number of dependent children she has, well, there was one on the original return, one on the corrected return. That is not changed. But other dependents, yes, she has one additional dependent, an other dependent, and that is Laura. So we have one dependent on the corrected return that was not included on the original return, so we have a net change of one dependent. We total up the number of exemptions, and the number of exemptions on the original return was 2. The number on the corrected return is 3. The difference is 1. And again, those numerical differences are described here. List all dependents that are claimed on this amended return. We've got Jane and Laura are the dependents being claimed. Moving down, we've provided a line description. Please attach any supporting documents, new or changed schedules, and of course we've attached the corrected schedules, so this return is essentially ready to go. In Part 3, we have described the line numbers and what we changed on them, and the net outcome of the amended return is that a refund is due to the taxpayer. Of course, Mary needs to sign it before she mails it in. This tax refund will take its sweet time in coming. The IRS generally takes 3 to 4 months to process an amended tax return. So that concludes the review of the classwork assignment. I did want to move back into the lecture portion of this course. And in the interim, between teaching sessions 11 and 12 of this course, the IRS did publish information on what it intends to include in their exam. And they have specifically said that they do want examinees to prepare for the exam by reading the instructions for Form 6251. Well, 6251 is the form for calculation of the alternative minimum tax. And in at least 2 sessions earlier in this course, I explained to you that, hey, alternative minimum tax is a more advanced concept, and I really don't want to have to impose that upon you. We do have a course on alternative minimum tax, a very detailed, in-depth course, runs a full 4 hours in length. And that is part of our CPE series called the Understanding the Alternative Minimum Tax. And we really get into a great deal of depth on AMT in that course. But I've always considered that to be a more advanced course and not really attempted to teach much to my basic students. However, since IRS says that they are requesting or that they will be testing on Form 6251, I felt that I needed to at least give you more information than I have up until this point. So at this time, I am going to give you a little bit more information about the alternative minimum tax and how it is calculated, and actually give you an illustration of what goes into the methodology of calculating AMT, so that when you hit that federal exam site, you aren't surprised. I don't like it when my students are surprised because I didn't teach them something. So, alternative minimum tax, here it is. You figure the AMT using Form 6251. Form 6251 is a 54-line form that identifies exclusion and preference items allowed under the regular tax, but limited or disallowed under AMT. Form 6251 is a complex multi-stage form which goes through 3 separate stages to eventually calculate the AMT a filer does or does not owe. The 3 separate stages can be summarized as follows. Calculation of alternative minimum taxable income, or AMTI. Subtraction of the applicable AMT exemption amount, which is subject to a phase-out. And calculation of the minimum tax under the AMT rate schedule, or calculation of AMT using capital gain rates. Your AMT liability is the excess, if any, of the tentative AMT amount above the amount of taxes due under the regular income tax alone. So you'll see what this particular paragraph means in just a minute. Calculation of alternative minimum taxable income. AMTI is the sum of 3 components. Regular taxable income for AMT purposes, AMT preferences, and AMT adjustments. Regular taxable income for AMT purposes is essentially the same as taxable income for regular purposes, except the AMT rules allow this amount to be a negative number. AMT preferences are items which provide for potential tax savings under the regular tax that are not allowed under AMT. AMT adjustments include any of the following items which are either restricted or disallowed under the AMT. They include exclusions, exemptions, and deductions, credits, or other treatments, such as a method for computing depreciation. Generally, there is no important economic distinction between preferences and adjustments, and the 2 terms can be used interchangeably. However, it is necessary to divide preferences and adjustments into 2 subtypes. These are called exemption preferences and deferral preferences. Exemption preferences are also called exclusion items, and they serve to increase alternative minimum taxable income by disallowing many of the more common deduction items that are allowed under the regular tax, including personal exemptions, the standard deduction, state and local taxes, and itemized deductions for miscellaneous expenses. Deferral preferences are subject to different timing provisions under the AMT than under the regular tax. Generally, deferral preferences affect taxpayers by accelerating income and postponing deductions. This means income is taxed now rather than at a later time. The most common deferral preference items include depreciation adjustments and incentive stock option income. Deferral items are numerous and require complex record keeping because taxpayers must generally calculate depreciation and basis amounts under both the AMT and the regular tax. Adding to the complexity further are calculations relating to the credit for prior year minimum tax, which may be available to taxpayers who have paid AMT because of one or more deferral items. Commonly affected taxpayers. There are 2 groups of taxpayers who are most commonly affected by AMT. Middle-income taxpayers are the most commonly affected by exemption preference items, which serve to increase taxable income. And high-income taxpayers are more commonly affected by deferral items. The Joint Committee on Taxation in 2007 has estimated that the three largest AMT preference items for 2006 were deductions for state and local income taxes. 63% of the people who paid AMT paid it because they claimed deductions for state and local income taxes. Another 22% of the people who paid AMT did so because they claimed personal and dependency exemptions that AMT does not allow. And the third most frequently disallowed item was miscellaneous itemized deductions. 11% of the people paying AMT had claimed this deduction, and it was disallowed under the rules for AMT. So let's take a look at Form 6251. It's divided into several parts. The first part, Part 1, is where you calculate your alternative minimum taxable income. For Schedule A filers, line 1 of Form 6251 begins with the amount shown on Form 1040 after itemized deductions and before the exemption deduction. So let's see what we mean by that. I'm going over here to the Form 1040, and we're looking at what line we're referring to. So the starting point for calculating alternative minimum tax is the line amount shown on line 41 of Form 1040. This is the income after claiming itemized deductions or the standard deduction, but before claiming the exemption deduction on line 42. So the amount entered on line 41 will carry over to line 1 of Form 6251. The next point of the Form 6251 is to start adding in income. And essentially, most of the lines in Part 1 of Form 6251 are used to add in items that were deductible or excludable from income under the regular tax, but are taxable under the alternative minimum tax. The first of these is medical and dental. Under the rules for AMT, medical and dental expenses are subject to a 10% limit rather than the 7.5% limit under the regular tax. Therefore, if you claimed medical and dental expenses on Schedule A, you will have an addition to income under the alternative minimum tax. On line 3, we add in taxes that were deducted on Schedule A, and it doesn't really matter what kind of tax, whether it was income tax, personal property tax, or real estate taxes. You are not allowed to deduct those under AMT, and they get added back in. Next in line is enter the home mortgage interest deduction, if any, from line 6 of the worksheet on page 2 of the instructions. Well, what that is about is that if you claimed an itemized deduction for home equity loan interest, and that loan was not taken out to purchase or improve the home, then it is an addition to income under AMT. So, for example, if you took out a home equity loan and you used the money to pay for student expenses or to pay off your car or to take a vacation or to pay off credit cards, that is an example of home equity interest that is not deductible under AMT rules. And if you claimed that type of interest as a deduction on Schedule A, you must add it back into income on Form 6251. Line 5 is where we enter miscellaneous deductions from Schedule A. So if you claimed any kind of deduction for miscellaneous expenses subject to the 2% limit on Schedule A, you have to add them back into income on line 5 of Form 6251. The list does go on from here. I'm not going to go through every single item, but I will point out the ones that I think are most relevant, including line 7, tax refund, shown on line 10 of your Form 1040. So the reason we have income being deducted on line 7 of the 6251 is that you are not allowed under the rules for AMT to claim a deduction for taxes. So if you get a refund of taxes that are taxable under the regular tax, they are going to be a deduction under the alternative minimum tax. We also have investment interest expense, the difference between the regular tax and AMT that is added back in. There could be differences in net operating losses. Another item of importance is interest from specified private activity bonds. These are exempt under the regular tax, but they are taxable under AMT. We also have to account for differences in depreciation, and we haven't even covered depreciation yet in our course, so I'm not going to get into this, but I did want you to see that there are a number of other items that are quite specific that are really beyond the scope of a first-year tax preparer. But these top items up here, I think if the IRS is intending to test a tax preparer at a basic level under AMT, they are going to be most concerned with the items that are entered on lines 1 through 7 of this form. Or they're going to be most concerned with items 1 through 7 and item number 12 on this form. So I'm going to be showing you in a minute an illustration of how Form 6251 is going to take or make adjustments under the alternative minimum tax rules for certain income and deduction items that have been claimed on a 1040 return. Now, Part 2 of the alternative minimum tax Form 6251 is used to calculate your exemption deduction. So when we get to line 28, we're totaling up our alternative minimum taxable income. From that point, we are allowed a single deduction, and that deduction is claimed on line 29. Depending on our filing status, we are allowed to claim a deduction. The deduction varies according to our filing status, and it begins to phase out when our income exceeds the income threshold for our filing status. If our income is equal to or less than this threshold amount, then the deduction we are allowed based on our filing status is shown here. It is a maximum of $47,450 for single, $72,450 for married filing joint, and $36,225 for married filing separate. If our income is higher than the amount shown for our filing status, we are subject to a phase-out and we need to complete a worksheet. It is called the exemption worksheet for line 29, and I've prepared that in our illustration that I will show you in a minute. When we are done figuring our exemption, we claim a deduction for that exemption, and then we have arrived at our income for purposes of calculating alternative minimum tax. And we will use a formula shown here for calculating that tax. And then the final stage is to see if our alternative minimum tax is greater than our regular tax. If it is, the difference is entered on line 35, and the amount from line 35 will carry over to line 45 of the individual 1040 return and adds to our tax on Form 1040. Now, Part 3 of Form 6251 is used to calculate capital gains taxes on alternative minimum taxable income. Now, under the regular tax and under the alternative minimum tax, capital gains do get special treatment, but under the alternative minimum tax, those calculations are more complex and affect other adjustment and deduction items. So again, we're not going to go into this. This is far too complex, but we do get into an in-depth discussion of tax computations for capital gains under alternative minimum tax in our CPE course called Understanding the Alternative Minimum Tax. So here's the illustration I've been promising you. Mr. Big Bucks has a 9-year-old daughter, Sally, who lived with him all year. Big Bucks had the following income and expenses for the year. We show wages of $300,000, tax-exempt interest of $2,000, but $1,000 of that interest was private activity bond interest. And of course, private activity bond interest is taxable under AMT, so we know we will have an adjustment or income item under AMT for that $1,000. We also have a state refund that was included in Mr. Big Buck's income, but under AMT rules, this state refund is not taxable. So that will be a deduction under AMT. On the expense side of things, we have medical expenses of $30,000. Well, we're going to have an adjustment under AMT for medical expenses because the phase-out or the limit on medical expenses under AMT is 10% rather than 7.5%. We also have mortgage interest expense of $50,000, but $10,000 of that was equity interest. And equity interest that was not used for home purchase or improvement is taxable under AMT, so I know that we're going to have a $10,000 addition to income on Form 6251. State income taxes and real estate taxes are deductible on the individual return on Schedule A, but these amounts will be in addition to income under AMT. And we've got Mr. Big Bucks also claiming employee business expenses as a deduction on Schedule A, and these too will add to his income under AMT. So let's take a look at his Form 1040 first. We can see here that we've entered on line 8B the tax-exempt interest income. $1,000 of this is going to be carried to his Form 6251 and entered on line 12 of that form as income. We're also showing $2,000 of taxable state refund. This amount is not taxable under AMT and will carry to line 7 as a negative entry on 6251. We have adjusted gross income for Mr. Big Bucks of $302,000, And we have itemized deductions showing on his Schedule A of $101,000. So let's go take a look at his Schedule A. Now on line 3 of Schedule A, we see the 7.5% limit being applied. His adjusted gross income is $302,000. We multiply that by 7.5%, and we get $22,650. That number is subtracted from the total expense, and the difference, $7,350, is his deduction that is allowed under the regular tax. But under AMT, his deduction will be limited, and the limit on his deduction is the lesser of the amount shown on line 4, or 2.5% of his adjusted gross income. The next item in line is his tax deductions. On Schedule A, he is claiming $30,000 of deductions, state income and property taxes. These will be added to income on his Form 6251. Mortgage interest is shown in full on Schedule A, and there's really no place on Schedule A to even indicate that a part of that number that appears on line 10 is for equity interest. But we still need to interview Mr. Big Bucks and establish that $10,000 of that $50,000 was equity interest, and that $10,000 will add to income on 6251. Down here on line 21, he has claimed employee business expenses on Form 2106. Miscellaneous itemized deductions that appear on line 27 are not allowed under the alternative minimum tax rules, so this again is going to add to his alternative minimum taxable income. But we see here that the total deductions claimed on Schedule A are $101,310. So let's go put that number onto his 1040 form. We enter that amount on line 40, $101,310. We subtract that from his adjusted gross income, and we get $200,690. Well, this amount on line 41 is the amount that will carry to line 1 of his 6251 form. So let's go prepare that form now. And here we are, line 1 is a carryover of line 41 from the 1040 return, and this is Mr. Big Buck's income after subtracting his itemized deductions. And the first thing we do is add back in that medical expense deduction. He's not allowed to claim it under AMT. We also add back in the tax deduction he claimed for income taxes paid to his state and property taxes paid on his home. We also add back in the home equity interest that was not used for home acquisition or improvement. We add in his miscellaneous itemized deductions. We subtract out the taxable state refund shown on line 10 of his Form 1040. And then on line 12, we add into income the interest from those private activity bonds. When we're all done with those additions and subtractions, we end up with alternative minimum taxable income for Mr. Big Bucks of $261,000. Next, we have his exemption deduction, but because his alternative minimum taxable income is greater than $112,500, we're going to need to refigure his exemption deduction for line 29. He will not be allowed to claim an exemption deduction of $47,450. He's going to be allowed a lesser number, and that lesser number is actually $10,325, but I'm going to show you how to calculate that. Now, another thing I did want to point out while we're here is that under the regular tax on Form 1040 allows you to go to the tax rate schedule and calculate tax for head of household. And head of household gets a lower rate of tax under the regular tax than a single filer does. And Mr. Big Bucks is filing as head of household, so he was able to go to the head of household tables and calculate his tax based on those schedules for head of household. Well, under AMT, there's no preferential treatment given to head of household. His tax rate for single and his tax deduction for single is the same as it is for head of household. So again, a tax benefit that was offered to him as a head of household filer is actually being taken away. But let's go see how we calculated this amount of $10,325. It's on the next page. And here we have his exemption worksheet for line 29. The starting point is that maximum exemption amount that he could claim if his income was low enough, and that's $47,450. We then look at his alternative minimum taxable income from line 28 of the Form 6251. We subtract from that $112,500 for being single. You can see right here it says to enter that amount, and the difference is $148,500. We then multiply that amount by 25%, and we're left with $37,125. This is the amount that he is not allowed to deduct. He subtracts the amount on line 5 from the amount on line 1, and he's left with $10,325. This is the amount that he will carry over to the $6,251. And here we have it entered, $10,325. We subtract that from his alternative minimum taxable income, and we get the income on which he must calculate his alternative minimum tax. On line 30, we have arrived at the taxable income for Mr. Big Bucks under the rules for alternative minimum tax. The next stage is to actually calculate the tax. We take $250,675 and multiply that by 28%. We then subtract out $3,500, and we're left with the result, which is $66,689. The next step is to compare the $66,689 to the amount of tax shown on line 44 of Mr. Big Buck's return. So here we are on Mr. Big Buck's Form 1040, and on line 44 we're showing his income tax as calculated under the regular tax. We're going to take this number, $45,609, and enter it on line 34 of his Form 6251. We then compare the tax shown on line 34 with the tax calculated under the rules for AMT. If the tax shown on line 31 is greater than the tax shown on line 34, then we are going to have an addition for alternative minimum tax that must be carried over to line 45 of his Form 1040. The difference between his tax under the regular tax and his tax under AMT is $21,080. $21,080 is the amount of alternative minimum tax that Mr. Big Bucks must pay. We take that over to Form 1040 and enter it on line 45. And you can see that the amount shown on line 46 is the same as the alternative minimum tax shown on his Form 6251 on line 31 and 33. So the amount on line 33, we want to see a match between that number and the amount shown on line 45 of this Form 1040. Now, by contrast, if we see that the amount on line 34 is greater than the amount shown on line 33, then Mr. Big Bucks would owe no AMT because his tax under the regular tax is higher. So in effect, the purpose of Form 6251 is to calculate tax under alternative minimum tax rules. And if the tax under AMT is greater than the tax under the regular tax, you will have alternative minimum tax that is added to the amount of tax shown on Form 1040. But if the amount shown on Form 1040 under the regular tax is higher than the tax calculated under AMT, then no AMT is owed. And now I'm going to give you the final password for today's session. That password is Saddlebred, SADDLEBRD. Please jot that down. It is the final password of the day, but please do not turn off video playback. I have some important information to give you, not the least of which is your homework assignment, but also instructions for completion of the Level 1 or the first half of the basic tax course. By this point, you should be completing your assignment for the open book midterm exam involving Buffy the Vampire Slayer. So you should have finished her tax return, and there is a video review of Buffy's tax return that you can watch. That video review is password protected, and you are allowed to watch the video review of Buffy's tax return after you have taken that test online. Now, the next part of the midterm exam, or the final exam for those of you who are taking Part 1 of the basic tax course or Level 1 of the basic tax course, is to take the closed book. We call it closed book exam, but it's essentially a computerized true-false multiple choice test, and you need to go take that. But I imagine you would like to have access to the answer key for Session 12's homework. You would like to have access to the Session 11 quiz answer key, and you would like to have access to the Session 12 quiz and quiz answer keys. So I am going to be inserting a second video into the Session 12 LMS, which will do a review of those very things. That is, the second video that I am placing into Session 12 is going to contain a review of the Session 12 homework assignment. It will contain a review of the Session 11 quiz answer key, and it will also contain a review of the Session 12 quiz. So when you are finished with this video, that is the Session 12 lecture video, please go ahead and do your homework and reading assignments for Session 12. And of course, the Session 12 homework assignment involves preparation of an amended return for Dr. Hewer. And if you remember, we prepared a tax return for Dr. Hewer in Session 7. But it turns out he forgot to include consulting income for the work he performed from his home on his original 2010 tax return, and he received a Form 1099 miscellaneous reporting $2,000 of Box 7 non-employee compensation. He also realized that he did not claim his daughter or his niece, Sally Hewer, who lived with him all year, as his dependent. So we would like you to prepare a corrected tax return for Dr. Hewer. So as we are at the completion of Session 12, please complete this homework assignment for Dr. Hewer. Do your reading assignment for Session 12 as you normally would, and when you are finished with those assignments, please go ahead and watch the second lecture video located underneath the Session 12 lecture video tab. That video will give you a review of the homework assignment for Dr. Hewer. It'll also give you passwords to unlock the answer keys for the homework assignment and the quiz assignments, and of course those quizzes being both Session 11 and 12. So thank you for participating in today's class. This is the final session for Level 1 or Part 1 of the Basic Tax course. From this point, if you are enrolled in Level 2 or continuing on with the full Basic Tax course, I will see you again at the beginning of Session 13. Good luck with all your exams.